Good morning. My name is Linda Rosenthal, and I am the chair of the Economic Forum. I would like to welcome the members, presenters, staff, and members of the public to our May 1st, 2025 meeting of the Economic Forum. I would like to thank the Legislative Council Bureau's staff for their assistance in setting this meeting up and their work today to allow this meeting's agenda to be completed. In today's meeting, we will have forecasts presented by the various forecasters of the state's major general fund revenue sources, and we will be approving forecasts for FY25, FY26, and FY27 for each revenue source that will be used by the legislature to finalize the state's budget for the 25-27 biennium. Additionally, we will review the Technical Advisory Committee's forecast approved at their meeting on April 23rd, and then approve a forecast of the minor revenue sources and tax credit programs. Finally, we will approve the Economic Forum's final forecast that will be provided to the governor and members of the legislature. As part of today's agenda, we will have a presentation by Emily Mandel from Moody's Analytics on their economic outlook and forecast for the sales and gaming taxes, as well as an updated employment outlook presented by David Schmidt from the Department of Employment, Training, and Rehabilitation. After that, we will proceed through the agenda items regarding forecasts for the major and minor revenue sources. Once the forecasts for all of the revenue sources and tax credits have been approved, we will recess to allow staff time to input our decisions into the forecast tables. I will also ask Mr. Nakamoto, as staff to the forum, to assist me as needed in conducting today's agenda. With that, I'll turn it over to Mr. Nakamoto for some opening remarks.
Thank you, Madam Chair. For the record, my name is Michael Nakamoto. I serve as Chief Principal Deputy Fiscal Analyst with the Fiscal Analysis Division of the Legislative Council Bureau. As Chair Rosenthal just noted, it is always our intent to take the break to allow us to get the tables updated, get everything squared away so that the final forecast can be prepared and approved for distribution. That we are aware as staff of an additional recess that we are going to need to take just so that the members as well as the public, either here in Carson City, down in Las Vegas, or watching online are aware. There are some technology issues that we are having in the building this morning. We have been requested to take a recess at about 11 o'clock, which is anticipated to last approximately 30 minutes to allow those technology issues to hopefully be resolved. That is all I really had to, at this point, Madam Chair, just to let everybody know kind of what the game plan was in terms of that. Thank you.
Thank you, Mr. Nakamoto, and I apologize. I think I missed agenda item number 1, which is roll call. So if we could go back to that.
Mr. Crum?
Present.
Mr. Gordon?
Present.
Mr. Levitt?
Here.
Ms. Lewis?
Here.
And Chair Rosenthal.
Present. Thank you. Moving on to agenda item number 3, which is public comment. I would like to ask if there's anybody here in Carson City who would like to make a public comment. Okay, seeing nobody, I will zoom down to Las Vegas. Is there anybody in the Las Vegas office who would like to make a public comment? Okay, seeing none, I would then finally ask the BPS staff if anyone has called in to provide public comment.
Thank you. The public line is open and working. There are no callers at this time.
Thank you very much. So agenda items number 4, 5, and 6 are approvals of the minutes from prior meetings. We'll start with the approval of the minutes from the October 16th, 2024 meeting. Do I have a motion?
Make a motion.
Second.
All in favor? Aye.
Aye.
All opposed? The motion carries. Agenda item number 5 is approval of the minutes of the November 7th, 2024 meeting.
Okay, that's right. Make a motion.
I'll second. All in favor?
Aye.
Aye. All opposed? Motion carries. And finally, agenda item 6, approval of the minutes of the December 2nd, 2024 meeting.
Motion.
Do I have a second?
Second.
All in favor?
Aye.
Aye. All opposed? Motion carries. Okay, we're halfway through the agenda, and it's been 10 minutes. Gets a little meatier from here. All right, next up, agenda item number 7, presentation of the National, Regional, and State Outlook, Economic Outlook from Emily Mandel, Associate Director, Senior Economist with Moody's Analytics.
And Madam Chair, Michael Nakamoto for the record, while Ms. Mandel is making her way up, to let the members of the public know the presentation that Ms. Mandel will be giving is in the Economic Forum meeting packet on page 195. This meeting packet is available both in this location as well as in Las Vegas, as well as in NELIS, the Nevada Electronic Legislative Information System on the Legislative Council Bureau's website. Thank you.
Great. Thank you, Chair Rosenthal. For the record, Emily Mandel. Are we presenting this? Let me get this. Perfect. Okay. So, I don't think this will come as a surprise, given some of the conditions that we've been hearing about lately in the news and in the data, but we have significantly downgraded our growth expectations for the United States and for the state of Nevada since our last presentation, our last forecast that we provided back in early December, I believe, of 2024. The primary cause of this, a reason for this, is the global trade war. We think that it will do real damage to the economy because largely of higher tariffs and the uncertainty that the rapid changes in this policy are generating for businesses, for households. There are multiple channels that this is passing through into the real economy, and I'll discuss some of the different ways that we're expecting this to manifest in the economy over the next several months, several quarters, as well as some of the various degrees to which those will translate through into the Nevada economy. So to put this more graphically, to put this to scale, I have a few different iterations of just national GDP. The main ones that would be of comparison here are the November 2024 forecast, which is the one that we'd provided in relation to the previous update here, versus the April 2025 forecast, the line in blue, which is our latest forecast for national GDP growth. And you can see here that GDP growth is predicted to slow to just over half a percent by the end of this calendar year. So we have our forecast that there will be a sharp reduction in growth at the national level, but still growth. This will technically avoid a recession. It will keep the economy expanding at a rate well below potential, but minor gains from quarter to quarter here. That said, this will be a fairly deep deceleration from where we've been over the past year. We've had quite a strong economy coming into this year. Even a lot of the hard data through the first quarter of the year have been quite strong. And so it'll be quite a significant slowdown, and that'll be felt by households and felt by businesses, just on account of that speed that we're predicting that things will begin to cool. Part of the, let's say, interesting part of forecasting at this point in time is that we're seeing a lot of the impacts of this trade war, these policy changes show up in the softer data, let's say, things like consumer sentiment survey, things like business investment expectations, but much of our harder data points are more lagged, right? They're more delayed in coming through. So we've still seen job growth be quite strong. For example, we haven't seen the GDP data for the most recent quarter. So much of this slowdown is based on our expectations and our assumptions for the economy. Now, this no recession baseline, this baseline where we avoid recession, it is contingent upon there being a pivot in trade policy. The fact that all of these announced tariffs aren't maintained for a prolonged period of time, that we get some trade deals, that we get some pullback there, and that we don't see all of these fully have their impacts come through into the economy. I'll show more about that later. Okay. So I mentioned that the economy, the labor market has been quite strong. Our latest data point from March had something like 228,000 jobs being added nationally. That's a very strong figure by whatever way you look at it. The April data point that has yet to come out will be the first data point after some of the reciprocal tariffs, so-called, were announced. So we're expecting things to begin to slow soon. But as of now, labor market, it's been quite strong. Now, we've seen, if you look further under the surface here, there have been some areas of slightly weaker performance, hiring, the rate of hiring and the rate of quits. So just that movement, that momentum in the labor market has come down. We're also seeing an increased rate of multiple job holders, so that can relate back to some financial stress by lower wage workers thinking they need to pick up an additional job. And then an interesting one here is we're seeing job seekers stay unemployed for longer, just taking longer to find a new job. And so it's become harder to get a job in the current economy, despite the fact that we're still seeing fairly strong job creation on net. So the dotted line here is our forecast for the coming year. And like I said previously, we're expecting this rate of job creation to slow dramatically and essentially stall out over the coming year. A lot of this has to do with uncertainty. If businesses are facing greater uncertainty as far as what demand will be for their goods, as far as what their input costs will be, they're more likely to hit pause. That doesn't mean that they'll be laying off workers. We don't have broad-based significant layoffs in this forecast, but they might let open positions remain unfilled. They might pull back on planned hiring they would have done otherwise. And on net, we'll see that start to wind down as far as the rate of job creation on net. I'm also happy to take questions throughout this, so Chair Rosenthal, if that's amenable to you, so please feel free. Okay. So I'd mentioned previously that much of this forecast hinges upon tariff policy. This chart here shows some of the key assumptions that we're making here as far as that trade policy. It gives a sense of the scale of these tariffs relative to history, as well as the timing and the direction relative to China, relative to the rest of the world. So what this is showing is the effective tariff rate, and it basically is looking at how much revenue is coming in relative to the amount of imports to get a rough measure of the magnitude of these tariffs. And we're expecting these to peak at roughly 21.5%. If we go back further, prior to the first Trump administration, we had effectively a 0% tariff rate. They weren't significant. We had an increase in tariffs in the first Trump administration that brought it up to 2.5%. So in comparison to that, this 21% that we'll see temporarily is very large. Like it's not an exaggeration to say that this is, these are significant. This will actually be the highest effective rate that we've seen since the early 1900s. So very much a change in trade policy. Now, we are expecting that these tariffs will only remain at that level for a short period of time. You can see that this effective rate, it actually peaks below 20 just because this is the average of the quarter. And we're expecting that they'll go into effect, we'll have some trade deals struck, we'll have some pullback as we start to see some pressure on the administration and some damage in the real economy showing up in those figures and wanting to take a step back. This is something that we've seen previously, even just with the initial announcement of the reciprocal tariffs and the then 90-day delay. So it's something that the Trump administration has been amenable to, flexible to in their decisions to change their policy in relation to feedback, in relation to what they've been seeing as a result of this and damage that different sectors believe they'll see as a part of this. Now, we have a rule of thumb rough rule of thumb, that every percentage point increase in the effective tariff rate reduces GDP by 6 to 7 basis points over the coming year. So if you do the math on that, a 19 percentage point increase in this rate would reduce GDP by 1 to 1.5% over the subsequent year. So seeing a quantifiable impact from that. Now, previous research has largely shown that tariffs are largely passed on to consumers, right? Businesses might try to absorb some part of these higher costs with an impact on profits, but the larger part of these will be passed on in the form of higher prices for imported goods that consumers will pay. In that sense, they largely act as a tax on consumer spending. Higher prices with revenues going to the federal government as a result of these tariffs. That impact of these tariffs, that anticipated impact as they start to go into more force, as some of these larger announced plans go into effect, has really had a detrimental effect on consumer confidence. You can see that this is dipped below that neutral line, and we've also gotten another month of data since this chart was provided, and so this has gone to 86, which is a 5-year low as far as consumer confidence. In times when the economy is, in good shape, it's chugging along, this is normally a lagging indicator. Consumers see how things are and they're, okay, we feel good. So, but before recessions, we see that causality change. We see confidence start to erode even as the economy remains in decent shape. So it's one sign that we're heading for a weaker economy here in the near term. There's another, in the past we've seen when we get a 20-point reduction over 3 months in this index, a recession will follow within 6 months. We're currently at 19.3%, so we're not there yet, but it's a reason, just one of the reasons that we have a weaker forecast that we've provided for you today. Now, this is soft data, like I've been saying, but consumers make up about 2/3 of the economy, and so there's real implications for what they're doing as far as their spending. One of the data points that we've seen happen in real time here is the impact on the stock market. We've seen declines in equity values here. We've seen a correction there. And there are many more stock market corrections than there are recessions. So it doesn't necessarily signal a downturn to come, but there's some reason that this will be more meaningful and more impactful than normally we might see. And that's because of what I'm showing you here, this distribution of spending by income group. Since the pandemic, we've had much more spending going by the top 20% of households. We've had an increase in spending by that lower 80% as well, as they've kept up with consumer prices, the dotted line here. But it hasn't really surged the way it has for some of the wealthier people. And that then translates into this potential risk to the economy through the wealth effect, right? As households see that their asset values are going down, they can become more cautious, save a little more, spend a little less. They're still going to be fine, like financially, it's not a point of a macroeconomic stress, but it's a place where, as we've seen them contribute so much to spending, even a small reduction in these spending plans can have implications for overall spending in the economy. We calculate the wealth effect to be about 2.5 cents That is to say that $1 reduction in asset values would lead to about 2.5 cents lower spending over the coming year, which sounds really small, but when you multiply it by this scale of increased wealth, it can be more meaningful. We do think, though, that housing is largely doing all right. It'll be fine. It's not going to be majorly affected. So that's another part of wealth that households have that is going to be relatively secure. So it's coming from financial assets rather than the housing market. Yes, please.
Can I ask you a question as relates to what we're doing today? When we did our forecast in December, it was our assumption, I think in general, that we were doing a conservative forecast. But I think since then, we've seen that our forecast of revenues for the current fiscal year are probably too high that we made back in December, and we'll have to reduce those today. But given that, do you envision that rather than for the next 2 years after this one, that rather than decreasing revenue from the current level, we would see probably a lower increase than we saw in December, but not necessarily a decrease from the level of the 2025 fiscal year? Is that correct?
It's a good question, and I think it'll vary by revenue type. Different revenue types will be impacted differently. At least this is what I'm showing in my forecast for gaming percentage fee and sales tax collection. We're expecting an increase in sales taxes, although not on the scale of what we expected previously, but we're expecting a decrease in those gaming percentage fees. So based on the elasticity of these revenue sources relative to the economy, relative to where we're seeing stress in the economy, some of them slower growth, some of them outright declines.
Yeah, the sales tax is an interesting one to me because I suppose we have a situation where tariffs can cause the cost of goods to go up, which would naturally increase the level of the sales tax. But at the same time, if they cause an economic downturn, then people will have less to spend, which would cause a decrease in the sales tax. So you've got the two in opposition to each other, and just how they relate is, I suppose, the difficult question.
Precisely. I'll actually move on to my next chart here, which shows this more or less looking at what we're expecting as far as nominal collections, right? The value of these sales relative to actual real collections, the volume. And so this is durable goods consumption in Nevada, only one source of it, only one source of sales tax revenues. But it's an area that can be more sensitive, right? If you think about buying your washing machine or your vehicle, these other like high profile purchases that maybe you can put off, we're essentially expecting the volume of these purchases to remain flat. So not anything close to this previous trajectory that we are expecting as people pull back. But we're also, like you said, expecting higher prices to flow through for these goods, expecting those nominal continue to rise. Slower than previously, lower levels than previously, but minor growth there. Of course. I'm going to just keep going here. Don't need to go back. But previous chart was saying that inflation expectations are up. People are expecting higher inflation as a result of these tariffs. And that makes sense, right? If those prices are passed along to consumers, they're going to see higher costs as a result of that. And this puts the Federal Reserve in a more difficult position, right? They have the dual mandate of price stability and full employment. These are moving in opposite directions as far as what their impact would be on policy, right? Higher prices would imply higher rates to combat that, but lower employment would imply lower rates. So currently they're kind of pressing pause. They're waiting to see how these things flow through. Our forecast expects that the full employment directive will, so to speak, win out over the next year, and we'll start to see rate cuts once again. We're expecting 3 rate cuts through the end of the year as they try to support the economy, and then additional rate cuts through the end of 2026 until we get back to neutral territory. because even with the declines we've seen, we're still in restrictive territory as far as rates, as far as lending conditions. And so we expect these to come down a little bit. We also do expect higher inflation in the near term as a result of these trade policy. We're expecting that to peak at about 3.7% in late 2025, so nowhere near what we had a couple years ago, but an increase from where we're at today, which is, I believe, around 2.4%. Now, this depends on two things, right? It depends on, one, these pivot on trade policy like we have built into these assumptions. It also depends on inflation expectations staying anchored, right? Meaning that tariffs inherently would be a one-time price shock, right? You see this tariff level increase, you see businesses start to pass this through. Maybe the timing of when that gets passed through changes, right? Maybe you'd see that for perishable goods that would come through faster, for goods that there's high inventory levels, maybe takes a bit longer. But altogether, each would be a one-time price increase. So in that respect, you would think that we'll have a bump in inflation, and then it'll level off or even to slow down a little bit as you get past these. If inflation expectations come unanchored, meaning that consumers start to expect we'll be back in a situation where we were before, that inflation will just keep increasing, that will stay at these higher rates, that would require some higher interest rates to control it. It's not built into our forecast here, but it's one risk to be aware of. So I'm going to switch over to talk a little more specifically about Nevada now, but if there's anything before then, I can. So Nevada has been slowing already before some of this slowdown we're expecting in the macroeconomy. That's mainly been coming from the leisure hospitality industry as well as retail and somewhat professional services. We've still seen some strong growth in healthcare, in government, some of these industries that are generally more stable, generally less tied to the tourism industry. But altogether, it's shifted down. On the vertical axis of this chart, it shows job growth over the past 3 months. Horizontal axis, it's over the past year. So you want to be up in that top right corner, but we've seen more recent job losses, despite the fact that on a year-ago basis, we've still added jobs in Nevada. And we've also seen a lot more divergence in this Western pack, probably based on their different economic drivers and things, but Nevada's just slowed a little bit faster than some of these other states. We do expect job growth to remain flat, to have some minor declines. We expect the unemployment rate to increase over the coming year, peaking in about 5.6, 5.7% in late 2026 calendar year. So some more slowness set to come for the state. As far as how these different channels will tie into Nevada, on the business side of the equation, meaning businesses' exposure to exports in terms of weaker demand, or retaliatory tariffs, or imports in form of higher input costs, Nevada's exposure is relatively limited compared to some other states. It's not a major exporter, and its manufacturing sector is not a huge part of the state's economy. And so in that sense, Nevada will be on a better footing than some states in the South or the Midwest that have much higher dependence on manufacturing. Of course, consumers will still feel the higher prices. That'll be passed through to Nevada. But in this one sense of the channels, Nevada's fairly insulated. One area that I haven't really talked about much as far as policy, but I mentioned it, I think, last time, is expected policy changes regarding immigration. This has already started to come, and we have a reduced forecast for international migration into the U.S. as a result of this. This will have a larger impact on Nevada than some other states, just because this foreign-born portion of the labor force is above average in the state. Industries such as construction and leisure hospitality would be most impacted by these reduced labor force. And this can put some upward pressure on wages, squeeze profit margins for companies a little bit because of this, this reduction in one portion of their labor force we're anticipating. Now, of course, most important thing here to talk about is tourism, right? And the expected impact on tourism. And this is an area where we're already starting to see some shakiness, right? Left side of this chart is visitor volume to Las Vegas, changed a year ago. Some of this is coming from convention traffic, just the change in the calendar there. We have one more data point since then as well, down 7.7%. So not a little bit better than this, but not really showing that it's leveling out yet. On the right side, we're looking at the Conference Board has a question they ask on their consumer confidence surveys about the number of households that are planning a vacation in the next 6 months. This is to the US specifically, and we've seen that fall pretty substantially. And I think this is coming from the more caution as consumers' eye potentially increase in price levels, higher expenses, which they are especially sensitive to after coming through the last couple of years, as well as some shakiness that they're expecting from the labor market. So one other point I don't have on here, we've seen some declines in the consumer price index for hotels and airfares, basically showing that potentially there's some reduced demand there. One other portion of an area that we'll expect will translate into some reduced visitation to Nevada and Las Vegas is international front. Canadians especially we've seen some pretty dire numbers about vacation planning by Canadians to the United States, reduced border crossing numbers. Now that's showed up mostly in land crossings, less relevant, but you would think that air arrivals would just take longer to show up because if you've already booked your vacation, you're not as likely to cancel it as to choose not to book a new vacation in the near term. Canadians make up about 13% or so. There's some variation in the statistical way that they're calculated, I believe, but around 10%, 13% of total visitors to Las Vegas. And so it's a meaningful component. If we see double-digit declines in that Canadian visitation, this would have a noticeable, measurable impact on Nevada's tourism economy. So we are expecting some pullback there in tourism as a result of this. Less on the domestic front, some reduction there because of confidence metrics, but largely on the international front. We could see it. There's been a lot of pricing pressure on vacations to Las Vegas, especially in terms of hotel rates, in terms of concert prices, things like that. Maybe if those came in a little bit on this weaker economy, we could see some stabilization domestically of people coming into Las Vegas. It's not something we forecast directly, but that could be a stabilizing factor, just reducing some of that pricing pressure that we've seen. But altogether, Nevada is a cyclical economy, right? They are more susceptible to the business cycle than the United States as a whole. So even if some of these channels for this most recent slowdown don't impact Nevada as closely, the tourism sector is very cyclical and they will feel the impacts there, and we will expect slower growth in Nevada as a result of that. Okay. That's everything I have here for the Nevada and US outlook. I can either talk about the revenue outlooks for this or come back later on.
I think I'd prefer if you could come with each source would be great. That's okay.
Now or later?
If you could come back when we address
Yeah,
each
no
one
problem.
of those
Sounds
specific revenue sources, that'd be great.
Okay.
Thank you so much. Oh, any questions? Yeah,
Yeah,
Mr. Crum.
I did have one question. Earlier in your presentation, you mentioned that you're not forecasting a recession, but that's under the assumption that things kind of start to turn. But you didn't mention exactly when things need to turn before you actually would begin forecasting kind of a recession. So what's that time frame look like, and what is your current assumption of when things start to
Right.
make that turn?
I should have highlighted this. So essentially, mid-year, around summer, it would need to be within the next couple of months to start to see this policy turn. We're expecting that the rest of the world would mainly be the source of the pivoting. Especially there is a trade agreement set to be signed with Canada and Mexico to be renewed in mid-2026. So we'd expect things to be resolved by then, but by summertime starting to see, for example, these very, very high tariffs on China be reduced, not anywhere near what they were before, but starting to see the reduction there. Thank you.
Thank you very much. Next, we'll have a presentation by Mr. David Schmidt, Chief Economist, Research and Analysis Bureau, Department of Employment, Training, and Rehabilitation on the state employment outlook.
Thank you, Madam Chair, and members of the forum. David Schmidt with the Data Research and Analysis Bureau for the record. I think you'll hear some similar themes in my presentation looking at the state's employment and unemployment data, as you just heard. Where we stand right now, I will emphasize when we look at the data we have so far, this is through March. And so all of the hard data is still at best a month before the announcement of tariffs and some of the shifts in policy there. Even the data that's coming out tomorrow, even though it's after that point in time, it's just about a week after because it's looking at mid-April. And so I think if you're looking at the timing on when will we start to see some of the data that really picks up on this, it probably still won't be even until the June releases of May data, because at that point we'll be looking at roughly where we are, today or a week or so from now. You heard Nevada has been slowing a little bit, and that's definitely true. Our employment growth rate was 0.6% over the past year in March, and that's about in the middle of the range that we've seen so far in 2025. We were seeing more significant numbers in 2024 in the data that was originally released. The benchmark revisions that use a more complete data set for employment flattened a lot of that out. And so that trend will be a little bit different as we go forward through the presentation. Our unemployment rate is currently 5.7%. That's basically steady. This year it's been in this sort of 5.5% range or a little bit more for the last couple of years, really, and so there's not a really significant change there. Labor force participation rate also steady, 62.8%. The U.S. in March is at 62.5%. And our hourly wage growth. This is a point that's been interesting because if you look at slowing employment growth and higher rates of unemployment, you might think much softer economy, but at the same time, we've seen these increases in hourly wages. Through 2024, we saw the hourly wage rate increasing basically as we move through the year. We are at 5.6 now. That's similar to where we were at the end of 2024. Where we stand nationally, that 0.6% growth is good for 32nd in the country. And I should say on the previous slide, I think the material in the packet says 0.7. That was a typo, so I have it corrected here. But 0.6% growth is about the middle section of the states. If you look at the middle 25 states, we would be in that range. 0.6% growth in the pre-benchmark data at the end of last year was about the bottom of the states. And so a lot of states have seen this shift where the original monthly survey data was more aggressive than the benchmark ultimately came in at. And it's solid. We aren't one of those states that's shrinking yet, but we have seen that pullback in our growth. If you look at details by sector, I know there's a lot of very tiny numbers on this chart, but if you focus on the two right columns, that's your annual change in percentage terms and the monthly change in hard numeric data. Most sectors have not seen a lot of change. The trend and the overall theme is generally pretty flat. You heard healthcare is called out as one of those sources of growth. Other personal services, which is a very broad spectrum of things, including auto mechanics, hairdressers, and lobbyists, all in that particular group is up 4% over the last year. Healthcare also up in that 4% range. Our biggest areas of weakness are in transportation, warehousing, and utilities. Specifically, the transportation, warehousing side, utilities isn't a big part of that particular sector. That's down about 4% over the last year and down about 1,000 jobs over the last month. And I will highlight, this is a trend that is not necessarily, I don't think it's really related to tariffs at all, because again, this is March data, so those hadn't really come into play yet. I think more, this is a sector that was growing very rapidly as we came out of COVID, and so as it grew very, very rapidly, I think the pullback we're seeing right now is more kind of a rebalancing of that sector as businesses respond to, okay, you know, how do we, you know, right-size our employment after seeing this really rapid expansion where we're up 35% compared to pre-COVID employment levels there. So it is pulling back, but I don't think it's necessarily a sign of shrinking or weakness at this point in time. I think it's more, again, that rebalancing of adjusting for the really rapid growth that we saw before. As I said, our hourly wage data is up, and that's generally true across sectors. The change over the last year has been pretty positive across a lot of them. Hours are also up, so we're seeing both wages and the number of hours people are working rising, with the exception of the construction industry. Their hours being worked is down about 2.5%. So in general, there's still that ongoing demand for labor is reflected in the wage data. To give you a visual of the trends that we're seeing, the next several charts all have a few things in common. Las Vegas is on top, Reno is on the bottom. They're all non-seasonally adjusted, and so you'll occasionally see some seasonal movement up or down. And in general, you will see the trend be very flat. All of the red areas are recessions, and so this goes all the way back to 1990. But if you focus at the top right part of each chart, you'll see over the last year and a bit, the trend really flattens out an awful lot. That dashed line across the top shows our current employment level, and you know, it will go through most of 2024 in this fairly flat kind of range in terms of employment growth. So for total non-farm employment, this is true. Also true for the construction industry. Construction industry is, I think, interesting to highlight because you just saw a chart that says a third of the people roughly working in construction industry in Nevada are foreign-born. For context, in the Great Recession, we lost 2/3 of our construction industry. We went from 150,000 jobs to 50,000 jobs. And you can see how long it took to recover those jobs. Even as there was demand in the mid-2010s, losing a workforce and then training the replacements in a highly technical and skilled industry took a lot of time. And so I think that is particularly relevant in the current context. You can see there has been steady and ongoing growth there, though again flatter over the last year or so. With the Reno MSA in particular, getting up close to where it was even in the Great Recession. And so it has been rebuilding, it has been responding to the demand that's out there. The Las Vegas MSA, because it boomed so much in the Great Recession, still taking a little bit longer, also hit harder by the declines that we saw in the Great Recession. Manufacturing industry, again, the same trend. It's pretty flat. We saw that rapid expansion post-COVID, and then it's kind of leveled off. This has been flatter for a little bit longer, but again, we don't have very large sources of growth. This is something that did change a lot in the benchmark revision. In our original data, manufacturing was growing much more rapidly, but as we got better employment data coming in, the survey was a little bit optimistic, and those estimates have come down. Retail trade, also mentioned before. Mostly what I think we're seeing here is you can see the seasonal peaks and seasonal valleys. We've been in a pretty narrow range there all the way back to about 2018. So it's been an area that's not for us a big source of job gains or job losses. Instead, the seasonal peaks get up to about the same spot, and the seasonal dips get down to about the same spot, and we've been in a pretty steady place. We have seen a bit of pullback. You'll notice those seasonal peaks get a little bit lower over the last couple of years, and I think this in part reflects the shift to online versus physical employment in the retail trade sector, but it's a broader story that goes back over a number of years. The logistics industry, again, transportation, warehousing, utilities, you can see kind of that peak and those sharper declines, especially over the last few months. Again, I think this is more a rebalancing because you can see how much it grew following COVID. Casino industry, obviously a major source of employment for the state, one that has been pretty flat for a long time. In Las Vegas, the peak for casino employment was back in 2006. In the Reno area, it was back in 1997 when the Silver Legacy opened. And so this has gone up, gone down a little bit, but generally what we've seen is in a recession, there's a bit of a decline in employment, and then that kind of holds off. In COVID, it saw a lot more recovery because of the nature of the job losses there, but it does look like we're kind of leveling off at a point that's a bit less than we saw through the 2010s. Food service has been sort of the opposite. And so if you look at the leisure and hospitality industry as a whole, it's pretty flat. It's up about 2% compared to pre-COVID levels, because what we have lost in the casino industry, we've largely added in the food service side. This brings us slightly closer to what the landscape looks like nationally. Nationally, in accommodation and food service is by far the dominant piece. For Nevada, because of the casino hotel industry, there's been a lot more employment in accommodation, and so this moves us slightly closer to national trends there. I don't think we'll ever get to that point, because obviously I don't expect the casino industry to go away. But by and large, what we've gained in one, we've lost in the other. There is a bit of a change in terms of the wages that are paid. Generally, the accommodation industry is paying about 50% more than the food service industry on an average weekly wage basis. Also looking at federal employment, this is something that has been potentially an item to watch, but really the story here is also very boring. It's been flat since early 2024. I do think a part of this is that as there are shifting employment levels at the federal side, the nature of how that happens matters a lot. Because if you take a deferred resignation offer and you're still getting paid, you still look like an employee, you're probably still showing up in this data until that fully takes effect. And so we might see a bit of a change here in the future, but so far there's really been nothing showing up in the data that we have to quantify that in terms of the number of people that are being paid. This is also true of our unemployment claims for federal workers. You can see in the week ending April 12th, there were 0 new claims coming in from federal workers. The week of the 19th, I just ran this morning, there was 1. And so this trend is really pretty flat, not something that would really have a big impact in our data. I think if you're looking at changes in federal spending and policy, the employment aspect is not a really big one. The bigger impacts would be things like the grants and the funding and the nonprofits and the other money that is being spent by the federal government, not necessarily on its workers. We don't have necessarily the concentrations of the types of departments that have been exposed to this. Our largest departments are Department of Defense, Department of Homeland Security, Veterans Affairs that haven't been as impacted. Our counties with the largest share of employment from federal workers is Churchill County and Mineral County because of Fallon Naval Air Station, the Hawthorne Army Depot. And so the civilian employees at those bases, still a large part of the biggest concentrations we have of federal workers at the county level, and then services in the Las Vegas and Reno areas. Those might be the areas that would be more exposed to shifts in federal employment levels. Looking at unemployment, our unemployment rate, as I said before, 5.7%, still number 1 in the country. It did inch down a little bit from 5.8 to 5.7%. The level of the shift was so small, we changed from rounding up to rounding down. So not a very significant shift there. We are one of 5 states that has an unemployment rate of above 5% right now. There is one state, South Dakota, down there with an unemployment rate of below 2%. If you look at the composition of our unemployment, part of this is because we have a higher level of labor force participation. We have more people looking for work who did not lose a job. They're unemployed for some other reason. If you set our participation rate to the 62.5% that exists in the U.S. as a whole, that represents about 8,000 people in Nevada. That would actually shift our unemployment rate from 5.7 to 5.2%. And so there is a noticeable aspect in which more people generally looking for work does prop up that unemployment rate a little bit. And I think it's important to think about the reasons for unemployment because this is a complicated chart, but on the vertical axis you have people, the unemployment rate for people who are not job losers. Any other reason, largely re-entrants to the workforce, new entrants to the workforce, and job leavers. On the horizontal axis, you have unemployment due to job loss. And the arrows here show the path over time going back to the early 2000s. And it's very clear the Great Recession is that large loop that goes up into the upper right-hand corner. The COVID recession is that narrower loop that shoots off to the right and back to the left near the bottom of the chart. Job losses are the really important piece of unemployment when it comes to recessions, because this is not necessarily people, I'm going to start looking for work. I'm moving back into the workforce. I've graduated from school. People can be unemployed for a number of reasons, but it's when people are losing their jobs that you have that really sort of material economic component to their unemployment. Right now, we are still at a point where we have more people unemployed for reasons other than job loss. You can see that kind of cluster at the lower left-hand corner of this chart. There's some early 2000s data and there's some mid-2010s data in there. Where we are right now is higher, but that means we have more people unemployed for reasons other than job loss than we saw in some of those earlier areas. So we'd have more people engaged in job search, not necessarily having lost their jobs. On the flip side, we do have people looking for unemployment longer. You heard that the duration of unemployment is increasing nationally. This is true for Nevada as well. This table shows 12-month average data going back to March of 2016. Down in the bottom right side, you can see some numbers in green. That's the change in the number of people who are unemployed fewer weeks, 5 to 14, 14 and 26, and 27 plus weeks. So we've seen a bit of a decline in the number of people who have been unemployed for the shortest amount of time, and we have seen increases in the number of people unemployed for 5 weeks or more. The total increases there, to sort of tie it back to the previous slide, if instead we had held flat and people, we weren't seeing people that were unemployed for longer periods of time, that does add about a percentage point to our total unemployment level. That's about an increase of about 16,000 people. Very rough numbers, but as people have been looking for work for a longer period of time, that does suggest it's getting harder to potentially find a job. We have more people looking, more people entering, but taking longer to find work when they do. This also shows up in our unemployment benefits. Unemployment is about 25% of your total unemployment, but it is much more tied to people who have lost their job. They had previous wages, they were fired, they start claiming unemployment benefits and they qualify it because they lost the job through no fault of their own. This is a number of different measures. The number of people coming into unemployment has leveled out, and we're about middle of the road nationally when it comes to unemployment claims. But the bottom couple of lines on this chart are the average duration of unemployment claims and the share of people who are exhausting or using up all of those benefits. And the increases that we've seen there over the last year are in the top 10 of the country. And the level of weeks that we're claiming, it's about 16.8 weeks. That is elevated. The level of exhaustions at 42.5% is probably 5 to 7 percentage points higher than we would have seen during the mid-90s and the mid-2010s. If you look at that average duration of benefits and draw it back through time, you can see that 16.8 weeks that we're at right now is actually comparable to where we were in the 2001 recession and a little bit above where we were at the height of the 1991 recession. And so it is a longer period of job search. I still think there's some adjustments. You can see that the line drops and spikes following COVID because of the nature of the impact of people moving through the system in some waves following COVID as their eligibility periods started to renew. But I think the increase that we've been seeing more recently isn't that same spiky thing. I think we got through some of those aftershocks, and this really does represent a increased time that it's taking for people to look for work. And so our labor market is one where people are slower to find jobs than we saw in the past. Moving into some forecasts, this all uses our QCW data. This is the more detailed employment picture that we get. We're in the process of finalizing our fourth quarter data, and so that last data point in the black line here is a little bit preliminary, but unlikely to change to any significant degree. It's mostly some cleanup in industry coding and things like that. And then in blue, you have a really quick trend-based model based on the data through 2017, and then what model best predicts the data from 2018 through 2024. In general, you'll see a lot of the same themes. We have been pretty flat in our survey data going backward, and a lot of the forecasts are pretty flat going forward. Here for total employment across all ownerships, industries, and sectors, we're looking at growth based on the trends through June of 2027 of about 1% in terms of total jobs. That's a little bit lower than the expected population growth, but long term I kind of expect employment and population growth to move in a pretty similar way, and so those trends do reflect, I think, the baseline expectations that we would have going forward. Looking at the construction industry, or NAICS 23, again, projected growth of basically zero. It flattens out an awful lot, just because that's the trend that we've been seeing most recently, and a lot of these will carry that forward. This is also true for Industry 48. This is more transportation oriented within that transportation and warehousing industry. There's more of the air travel, passenger ground travel, and things like that in Industry 48. And the trend there, again, is essentially flat. For Industry 49, this is warehousing and a little bit more logistics oriented, also includes things like the Postal Service, 0% growth. Industry 56, professional and business services, growth of about 0.7%. So a little bit up, but in that same kind of ballpark. There aren't a lot of industries that are showing much more rapid growth, probably outside of healthcare and social assistance. As the population gets older, that demand for healthcare is steady. I don't have it in here because it's essentially a line that you continue forward and upward at about 3%. Finally, for these projections, the casino industry, again, as it's had that very flat trend coming out of the last few recessions, expect that flat trend to continue to carry forward. So all of those are the trend-based forecasts. Obviously, as you just heard, there's a lot of economic uncertainty out there today. In trying to grapple with how or whether those expectations should be pulled into the presentation, I took the route of I don't know what tariff policy will be 6 months from now. And if I don't know, then I don't have any really firm data to react to. And so instead, it's like, here's the trend that we have. And then obviously, depending on the policy that comes out, the details of that will matter an awful lot. Because, for example, Nevada, relatively low exposure to tariffs in general, has the highest share of imports to the state that come from China of any state at 26.6%. But those imports are heavily concentrated in communications and electronic equipment. I think largely because of phones and small things being flown in because of the closer distance that we have to China. And so if there's a tariff on China, but it exempts communications and electronics equipment, that would be a very different thing than just looking at the overall tariff rates. And so I think the details matter enough that there's no certainty on how exactly to project that yet. But the one thing I think we do know is that uncertainty does make it harder for businesses to invest. And it does itself act as a slowdown on growth as businesses kind of keep their powder dry and pull back from engagement and defer making some of those decisions until they know how they can invest. As businesses are doing that, as consumers are doing that, it's that collective pullback in activity that does itself lead to typical recessions. As we've gone through the Great Recession and then the COVID recession, we've had sort of large shocks to the economy. But the more typical recessions we see as we look further back in time in 2001 or 1991 were less the incredible shock than that smaller pullback. There's something that causes people to just kind of wait a little bit and see and make some adjustments. And I think that collective pullback is certainly the biggest risk. As I were projecting forward, trying to incorporate all of this, I would be pulling back those growth forecasts from what's essentially flat to probably something negative, at least in the short term, while we're looking to see how this will affect the economy here. I do think that there's a little bit more hard data about what's happening with the supply chain, the number of blank sailings that are taking place across the Pacific, and some potential acceleration in the downward trend that we've seen in the logistics industry that's started to manifest so far. But for other industries, I think it's more the uncertainty than any reaction to any specific policy that would probably be depressing the employment forecasts. And with that, that's all the slides I have for you, but I'm happy to answer any questions you might have.
Based on what you were just saying, I'm wondering, say for instance, if you were a company, any kind of company, and had plans in the past that you're going to start a big construction project in this next year, and based on what people in general are feeling about the economy right now, I wonder if perhaps it would be the natural disposition of someone to say, well, I will not start that construction project now, I will defer that. And of course, if they defer that, then as the current construction comes to, ends and we don't have anything to replace it, is that an accurate description of what could possibly be happening here with this, particularly that segment of the economy?
Yeah, David Schmidt for the record. I think certainly that's a reasonable assumption to make. I think, obviously in an economy of 100,000 businesses, not everybody stops. And so I wouldn't say that it's necessarily systematic, but it's more people choosing to stop than to keep going, because you will also have the businesses like there's an available labor pool. I think that I can still earn a profit. I think that for me, it makes sense to go ahead and invest. But if you have more people pulling back than you have choosing to invest, that's where you see some general slowdown. And so I think it's important to sort of disentangle the specific items from the net balance. But I think on net, that's probably what I would expect is a few more people holding back and waiting, keeping their powder dry, looking for the good investment, looking for a guaranteed return, having some level of decrease in terms of overall activity.
Yeah, Mr. Gordon and I were talking before the meeting started about if you feel the economy is going to be bad, that can be a self-fulfilling prophecy, because you react in such a way that you don't spend money because you're nervous about it. And then, of course, the fact that you don't spend the money, then it reduces the whole level of activity.
David Schmidt for the record, I would totally agree. I think expectations matter an awful lot because expectations become your reality as you act on them.
Linda Rosenthal for the record. Just to get your personal views on a few things. So that uncertainty that obviously is looming out there, what's your best guess of what impact that's going to have on employment and wages and going forward?
David Schmidt for the record. If I were looking back, I think it's hard to come up with a certain number, which is obviously the challenging task you have today. I think a lot will depend. If it were just the uncertainty, if we're going with kind of the baseline Moody's outlook, by sometime in the summer we start to see some, issues get resolved. Maybe there's some increase in costs, but it's not necessarily 145% on China and 30% on everything else. I think there would be certainly some impact, but I don't think it would be like Great Recession or COVID or the large disruptions that we would see. I think you might see something more akin to what we experienced in the 1991 or 2001 recessions in terms of a dip in growth. It would come at a time when Nevada is not growing as fast as it was back then. We spent most of the 80s and 90s and 2000s growing at double the rate of the U.S. as a whole, and so those recessions were very mild for us because it was against a baseline of really incredible growth. We dipped, and then we kept right on going with barely a speed bump. I do think we would probably see a bigger impact to our economy just because we're going from a much flatter baseline trend, and so I think a dip of a couple of percentage points would certainly be reasonable. At the same time, we have the background of pretty strong wage growth. There is pretty solid demand, and you have the potential for a very tight labor market because of changes to immigration policy as well as an aging population, reducing that available supply of labor. So I think that might offset the impacts to jobs a little bit, because as you have that tight labor market, it's not that jobs are necessarily very hard to find. It might be challenges connecting someone dislocated here, getting a job over here. But I think that might tend to help support employment, at least prevent it from falling, if not necessarily contribute to it rising, because we're talking about a tight and restricted labor supply. I think that could help also to keep wages a little bit higher and keep them from seeing the same sort of vicious cycle you can get in a typical recession. Yeah, I think a couple of percentage point decline, probably not unreasonable, given that we were recently growing at 3%. And in a labor force of 1.6 million people, a change of 1% is 16,000 jobs. So could we see 16 to 32,000 jobs affected? I think that's certainly in the realm of possibility.
Linda Rosenthal again for the record. It's interesting because when you think about so many of our taxes that we're going to forecast are based on consumer spending, right? It's the health of the consumer. So trying to figure out what that looks like when you've got, worsening macroeconomic conditions. But when you talk about the specifics, especially for our state, it's higher wages, it's steady unemployment, or steady employment. All the things that sound like it wouldn't have as big a negative impact on the consumer. So what's your view of the health of the consumer through all this?
David Schmidt for the record. I think it depends a lot on the details. As you heard, we have an economy that's more highly concentrated in leisure and hospitality. I think I saw some analysis from Sieber down at UNLV that was saying that Canadian travel to Las Vegas supported more total jobs than the manufacturing industry in Las Vegas. So it is a significant thing that's certainly exposed. If we have nationally a slowdown in domestic travel, I think domestic travel is still by far the biggest thing driving tourism and visitation in Las Vegas. I think that would leave us more exposed. Slowdowns to travel from Canada, probably the next biggest risk. You saw on the chart that travel from Asia, while big for individual spenders because they tend to be much more wealthy and they can try things like baccarat play, I don't think is as big for the average worker in the Las Vegas area as the sheer number of people that travel from the U.S. and North America. And so being in an industry that's already, when there's a downturn, it tends to drop and not necessarily come up as much as businesses find ways to operate a little bit more lean. If you are a consumer, to get kind of the question that's working in that industry, you're probably a little bit more exposed and you're a little bit more at risk. If you are in one of the skilled trades where you're building infrastructure for other businesses, I think as we're still working our way back toward having enough capacity to do that work, you're probably a little bit more protected than you would be there. I think you have seen the level of quits falling, so there's a little bit less confidence, but they're also falling from very, very high levels in 2022 and 2023. The level of quits that we see is just now getting back a bit below where it was in 2018 and 2019. So in 2018, 2019, you'd say this is a pretty confident economy. Things are growing pretty solid. It was a positive place. I think we've fallen, but it's important to remember we're falling from 22 and 23 when it's I can leave this job and get one of 5 jobs very easily at the drop of a hat. That's less the case than it was, and we're not at 2019 levels. We have continued to slide past that, but we're also not at 2009, 2010 levels. There is still enough demand for workers out there that I think there's still solid opportunities. I think it's more just the capacity of the economy. As we've recovered from COVID, we've grown 9 or 10% beyond where we were prior to COVID. I think the biggest restrictions are more just the overall level of employment that's demanded by the businesses that we have here. But I don't necessarily think that it's I can't find work. Clearly, we have people entering the job market thinking that there is work out there for them. It's taking a little bit longer to find those jobs, but I think that's still relatively strong overall.
Thank you. Any other questions? Thank you very much. So I will turn the floor over to Mr. Nakamoto as we consider this recess to reset the technology.
Thank you, Madam Chair. Michael Nakamoto for the record. The recess, I've been working with our AVH staff and the director of the Legislative Council Bureau to kind of get this set up. We're at a point now where we could take that recess so they could do the camera reset. One of the other things that we do have going on, though, is we do have somebody who needs to catch a flight, who needs to be out of here by about 12. So given that, I will leave it up to you, Madam Chair, to see how we handle this, whether we have Ms. Mandel come up and run through her forecast real quick and just go back to that agenda item, or whether we do the recess now and then have her come back after that. So that'll be up to you.
Thank you. Linda Rosenthal for the record. If it's not too much of a burden on the state, if they could wait and let her go ahead and give her presentation so she's not as stressed getting to the airport, I think that'd be great. So
Then at your direction, Madam Chair, we will have Ms. Mandel come back up. We'll go back to that agenda item and allow her the latitude to continue her presentation or conclude her presentation. And so let me get her slides up.
thank you.
For the record, Emily Mandel, Moody's Analytics. I do apologize for this. I am not the most flexible place to get flights out of, so. Okay, hopefully this doesn't, impact your processes too much. But let me I'm going to present the outlook that we're thinking for the sales and use tax, as well as the gaming percentage fee following that. I'm sure you will get more information on this later on, but there was a change with the processing system for payments for sales and use tax, so these will look a little bit distorted, but I'm going to talk about the outlook we're looking here. We've attempted to compensate for, well, essentially, there's two lines here, right? One, the blue line here is the data as provided, acknowledging that there was some underreporting because of a change that they're making in how these are recorded. I'm not going to get into the weeds of this here because there's people better qualified to explain that change. But if I were to compensate for some of this, we would get us to the dotted line as far as the revenues, if we are trying to take an apples to apples with what things were beforehand. Now, in forecasting these revenues, I have discounted the recent data that is distorted. So the actual revenue levels, with the exception of fiscal 2025, which does include the data as provided, should be what we would expect based on underlying economic conditions, so those fiscal 2026 numbers and the fiscal 2027 numbers. So the overall trend that we are expecting for sales and use tax collections is a modest decline in the current fiscal year, followed by growth in the following 2 years. Compensating for this, basically the path of the dotted line and the numbers to probably think about for a year-to-year perspective would be a 0.9% decline in fiscal 2025, followed by 1.6% growth in fiscal 2026. And so essentially the forecast calls for this gradual growth, 1.6% in 26, 1.9% in 27, as our baseline outlook here, aligning with those projections for the economy we discussed earlier. Now, this is very much below the potential rate of growth that we'd expect in normal times in the Nevada economy because of this weaker labor force, because of this reduced consumer confidence here. But we would still expect growth. A lot of this is stemming from rising prices because consumers will be forced to absorb some of these higher costs just to maintain their quality of life there. But growing below the pace of income growth we'd expect for the state, and also growing below the pace of inflation itself, so a reduction in the real level of purchases. To construct this forecast, we look at a few different metrics. We look at U.S. recreational spending, so to get a sense of that spending by tourists in Nevada as one component here. We also look at more, homegrown measures of demand, things like the durable goods purchases that I showed earlier, personal income, and the unemployment rate in Nevada. So as we have some weakness coming from the unemployment rate, that rising a little bit, slower growth in income, all of that translates into this slower growth that we're anticipating here for sales and use tax collections. And with that, I'm happy to take any questions.
Thank you, Madam Chair. Brian Gordon for the record. Appreciate the presentation. Maybe you can just give a little bit of color, if you can, on the breakout between how you sort of think about the projection from a tourism-based economy. You sort of mentioned looking at things like U.S. recreational spending versus the homegrown. I think was sort of the reference, from consumers that live in the state of Nevada. Is there a distribution or a differential that we should be thinking about in terms of how fast or slow those subsets of potential sources of sales and use tax perform? Is that a fair question?
Sorry. In part because so much of Nevada's employment base and wages are tied to that same industry, right? So the unemployment rate tends to move in tandem with the health of that tourism economy. So from that perspective, it bleeds over into that kind of homegrown part as well as these people go home from work and spend their wages. But I don't want to undercount the value of Nevada's rapidly growing population. That's just, as that population grows, that's just an inherent source of increasing demand for these sales and use. We don't have a specific weighting to answer your question. It's essentially what our kind of regression models tend to put those coefficients at, comparing these different parts. But that is part of the reason that we include that recreational spending metric just as its own thing to make sure that we're incorporating that. So unfortunately, I don't have a clear answer for you percentage-wise. Hopefully one of the later presenters will have this. But
That's great. Thank you.
okay, so apologies again for disrupting your flow of show here. But to shift over to gaming percentage fees quickly, this is one area where we are expecting outright declines in revenues in fiscal 2026 particularly. There is also the potential for fiscal 2025 to be a little bit weaker than I have put here. I just want to acknowledge that that is definitely a very real risk. After this, after finalizing these numbers, I received an additional month of data once that was released, and that was down 8.3% for April. So not a great start to that fourth quarter here. So just to acknowledge that potential discounting for the fiscal 2025 coming in here. So to construct this outlook, once again, we are putting a few different pieces together. First off, we look at forecasting the visitation to Las Vegas to try to get a sense of how many people are actually coming. I think in the current environment, that's especially important. To do that, we look at recreational spending in Nevada. We also look at the strength of the dollar and the national unemployment rate to get a sense of how the economy is doing, how affordable a vacation is for international visitors, and just how much spending there is kind of in general going on in the state as another indicator here. We are expecting a decline in that metric. We're expecting fewer visitors to the state. This is a rougher forecast than some of those, but those that model has us expecting about a 7% decline in visitation, peak to trough, in that time period. That would be a little bit less than we saw in 2008, more than in 2002, to get a sense of, in the dot-com bubble, to get a sense of compared to different previous recessions. Like I said before, I would expect a larger part of that to be coming from international visitation. Now, that metric of visitation then gets combined with measures of income and as well as unemployment in the state to pull together this sense of how much the actual spending on gaming will be, how much of the revenues will be coming through on there. And we put that together, and we do expect a decline in gaming revenues. Of course, they've been very high recently. We've had some leveling off. We've had that stabilize a little bit in recent years. It hasn't been quite as strong as we've had some of these higher profile events take place and then going off of that higher base. So this 5.6 decline we're expecting next year is coming off of that higher base there, but it will bring us back to levels that we haven't really seen since this recovery was made in fiscal 2022. So definitely some more weakness there. We'd expect a start of a pickup, mild pickup, 2.2% growth in fiscal 2027 as the situation begins to stabilize, the economy begins to improve, especially towards the end of that fiscal year, and people feel comfortable again booking these vacations and maybe spending more in the state on these vacations. With that, are there any questions about this forecast?
For the record, Linda Rosenthal, I just have one question. So like you had mentioned earlier, like the forecast for these revenue sources are going to vary tax to tax because they have different drivers. But in particular, this gaming percentage fee outlook for your forecast is quite a bit more dire than the sales tax. I know you mentioned the inputs that go into this, but just what level of assumption of, I guess, macroeconomic pressures do you have in this forecast? It sounds like it's a lot is being baked in, a lot of negative possibilities are being baked in with a pretty extreme decline expected here. I just want to understand the level of, I guess, what's baked into the assumptions.
Of course. For the record, Emily Mandel. I'm really hesitant to say that there are not still substantial downside risks in the current environment. So we're expecting a decline. I don't know that I would call this dire relative to the realm of possibilities. I don't know if that's too downbeat for this to say. Kind of that same metric that I was looking at before in comparing visit volume in past recessions, looking at the same thing around gaming revenue. In 2008, for example, I believe peak to trough, it was something like 23% decline. So it's a very cyclical series in the past, this gaming revenue fee. And I think the major differentiator between the stronger forecast for sales tax and the much more downbeat gaming percentage fee forecast is that it's inherently discretionary, right? You're going to have to buy, a car eventually. You're going to have to buy, goods and different taxable items there. You aren't necessarily going to have to book a vacation, or if you live in Nevada, you aren't necessarily going to have to, spend an evening at a casino. And so I think there's just a lot more flexibility there. There's a lot more elasticity there in terms of this spending, and that's the reason that we've got greater downside here.
Thank you very much. Any last questions?
Right.
Safe
Thank you so
travels.
much, and thank you for letting me make my flight. I appreciate it.
Mr. Nakamoto, do we want to go into formal recess at this point? Do you have a sense of the time, how long we might? 30 minutes? Okay. So it's about 11 o'clock. We will formally recess till at least 11:30.
Good morning. Mic check 1, 2, 3, 4, 5, 6. Mic check 1, 2, 3, 4, 5, 6. How are we sounding today?
Sounding real good on the Zoom, sir. Leo is asking that if you could please double check the display settings on the witness laptop while you're there. And I'll count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and over to Gary.
Thank you. Mic check 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and over to Wakanda today. Thank you.
You guys sound good to me in the room. Mic check 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. How do I sound to you all?
Good in Carson? Screen share looks good in Carson.
Screen share looks good in Vegas.
And there's the nod. I'm going to go over to the presentation laptop and I will get in touch with Mr. Leo to make sure we can see that everywhere.
Awesome. Thank you, Chuck.
Thank you very much.
Thank you.
Okay, good morning. We are going to formally re-adjourn the May 1st, 2025 meeting of the Economic Forum. Reconvene. We are on agenda item 9, which is the presentation of historical taxable sales and gaming market statistics. And for that, I'll turn it over to Mr. Nakamoto.
Thank you, Madam Chair, members of the Economic Forum. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. This is the agenda item where we come in and say that there are the series of taxable sales and gaming charts that the Fiscal Analysis Division updates, and that those are available in Nellis. I can say that safely about the gaming statistics. The Gaming Control Board put out the latest month earlier this week. We have those updated for the latest month, and those are on the website. Taxable sales is a different story. There is going to be a discussion in the next agenda item relating to the upgrade of the Department of Taxation's computer systems and their modernization. What that has done, though, is has caused a change in the series for taxable sales. So the taxable sales statistics that are on the website are updated, but they're only updated through October of 2024. That is the latest information that we have under the old series. Your forum staff is working with the Department of Taxation to come up with a brand new series based on the way that the taxable sales are now being reported. That just was not able to happen before this meeting. Hopefully by the time we get to the next meeting of the Economic Forum in December, we will have that rectified, but we have the most latest, the most recent information relating to taxable sales that was we were able to obtain that is a relevant and manageable series. So with that, I will answer any questions. Otherwise, we can move on to agenda item number 10.
Thank you very much. I see no questions. With agenda item 10, the members of the forum have received a letter from the Department of Taxation, which is also available to the public, which provides an overview of the rollout of their computer system modernization and the effects on revenue distributions during the current fiscal year. At this time, I would like to have someone from the department come forward to provide additional information and answer any questions that members of the forum may have about the letter or the change in the computer system.
Actually, Madam Chair, Michael Nakamoto for the record, if we could, just to accommodate the, could we consider taking the agenda as items out of order? And before we get to the Department of Taxation, the State Treasurer's Office should be down in Las Vegas. And if we could have them come up and just do interest, as they have another obligation that they need to get to here shortly. If we can have them do that, and it should not take very long for them to go through interest, because it is a consensus forecast between our, the Treasurer's Office, the Budget Division, and Fiscal, and then we can have the Department of Taxation come up and talk about Mint and go through all of that.
Perfect. Yes, that's fine.
So, Madam Chair, while we're waiting for the Treasurer's Office to come to the table, I will just point you to the interest or the interest projection materials that were submitted by the Treasurer's Office. It is in the Economic Forum packet on page 293, and I am bringing that up on the screen now. So everybody should see that, and I believe I did see Mr. Hale at the table down in Las Vegas.
Good morning.
Thank you. Good morning. Hi, good to see everyone again. Sorry about that. I thought somebody else was leading after recess. For the record, I am Stephen Hale, Deputy Treasurer of Investments. I would like to briefly walk you through the changes to our interest earnings projections. Starting with fiscal year 25, we now see about a $6 million increase in projected interest versus our December forecast. This is largely due to the benefit of having actual data for the first 2 quarters of fiscal year 25. The first 6 months actual was $6 million better and fully explains the difference from the earlier projection. For fiscal years 2026 and 2027, our projected interest declined by 14 million and 11 million respectively. This is primarily explained by lower forecasted interest rates in those years. However, another factor was a small decline in projected fund balances. This is a result of taxation's implementation of a new accounting system earlier this year. This new system allows for the calculation of the consolidated tax to be completed more quickly. The state treasurer and taxation both believe it is important to deliver those funds to the counties as quickly as possible so that the counties can continue to provide vital services. Historically, the state would have had the funds for up to 60 days of investments. We now project that it will only be in state coffers for 30 days, therefore a slight reduction in both the balance and interest earned. That concludes my official remarks. I welcome any questions you may have.
Thank you, Mr. Hale. I don't see any questions from any of the forum members. So thank you for your presentation.
Okay, thank you. Take care.
Okay.
So, Madam Chair, if this might be a good time if you wanted to take a motion on accepting the consensus forecast.
Yes, thank you. I will entertain a motion to accept the consensus forecast for interest income for fiscals 25, 26, and 27.
Make a motion.
I'll second the motion.
All in favor?
Aye.
Aye.
All opposed? That motion carries. Now we can move forward with the rest of Agenda Item 10, the review and approval of the major general fund revenues. And we'll start with the presentation from Erica Scott on the new system for calculating and tabulating sales tax. Good morning.
Good morning, Chair Rosenthal and forum members. For the record, I'm Erica Scott, economist with the Department of Taxation. Before I present the forecasts, I would like to address some of the changes that have occurred since the last meeting, which have altered the timing and reporting of revenues for the tax types addressed in this forecast. The department has launched the first phase of the state's new modernized tax system under Project Mint. MYNT is also the acronym used to describe the new tax system known as My Nevada Tax, which includes the department's e-services portal for taxpayer account services, reporting, and payment. Project Mint is set to be implemented in 3 phases in December of each year, with the first phase having been implemented on December 9th, 2024. The following tax types were included in the first implementation of the Mint system: sales and use tax, consumer use tax, cigarette tax, live entertainment tax, liquor tax, and all liquor, tobacco, and other tobacco products license renewals and fees. The Phase 1 tax types were planned out to include all taxes and fees associated with the consolidated tax distribution, as well as some other common taxes and fees. The Phase 1 tax types were planned out to include taxes and fees, at the outset of, I'd like to clearly state for the record that there have been various observations or concerns that the new Mint system have negatively impacted revenue to the state. However, what my presentation today will clarify is that the new Mint system offers a new type of revenue reporting and indeed a faster distribution cycle for realized revenues. Notwithstanding, during the transition to the new Mint system, the department experienced some temporary fluctuations in the reported revenue. These fluctuations have been resolved, and I will explain hereafter any true reductions in the revenue relate to economic conditions and not lost or missing revenue as a result of the new system. On slide 3. Some differences between the old system and the new system must be discussed since there was temporary revenue impact during the transition based upon the manner in which the revenue is now reported, and as the department had worked through certain taxpayer reporting and payment errors. Under the old system, the department historically reported monthly revenue and tied that revenue directly to business activity period or filing period. For example, the department reported monies collected in March of 2025 as February 2025 filing period receipts, since the February filing period was due by the end of March. This method could be used as viewed as a partial accrual accounting method of reporting. To most accurately attribute monies received within each month to a filing period, the department focused on reconciling business activity for that period during each fiscal period close. The old system also held on to any early paid periods that were not yet due as future revenues and would not distribute those funds until the due date had passed in the future revenue period. With the first rollout in Mint, the department transitioned the reporting of revenues for these tax types in Mint to a cash accounting basis with statistics on the business activity or filing period reported separately from the revenue period totals. Revenue periods now close earlier and reconcile monies received during a given period regardless of the filing period with which the payments are associated, which represents a true cash accounting method of reporting. The department will be able to provide additional reports that show that March 2025 revenue consisted of payments that were paid primarily from the February 2025 filing period and any additional late payments for previous filing periods. I would like to speak to the taxable sales report. So the taxable sales statistics out of Mint are now reported for specific filing period based on what taxpayers have reported up to the point specifically tied to distributions, of what taxpayers reported up to the point of the date the report is pulled. So this is based on filings that taxpayers have submitted to the department. The old system generated a taxable sales statistical report specifically tied to distributions of funds received during a revenue period. In the old system, if a taxpayer filed and paid a late return that was due during a prior revenue period, the taxable sales would then show up in a current revenue period despite being attributed to a prior business activity or filing period. This method of reporting also included attributing all of the taxable sales in a filing period when only a partial payment was received during that revenue period. The new way of obtaining the taxable sales is more directly related to current business activity, with the consideration that there will be some late filers not captured in the data should they file over 30 days late. Also, the taxable sales statistics for the November, December, January, and February filing period are being uploaded onto the website. If they are not available already, they should be later today, and with a memo, of course, telling users of the statistics what has changed from prior series. And the department is also working with LCB and GFO on providing historical data pulled in the same manner, which will be a project that I will be overseeing. So notably, the total distributions since the December 2024 revenue period have reflected a split in revenue from different filing periods. Specifically, the December revenue period reflected a portion of monies collected for the November filing period. The other portion of November's filing period was then distributed in the January 2025 revenue period. Moreover, for the January revenue period, a portion of the distributions were derived from the December 2024 business activity. Finally, for the February revenue period, a portion of the distributions related to December 2024 business activity and the other portion for January 2025 business activity, and so forth. In summary, where various portions of the revenue from each reporting period are distributed in the first month and the other portion is distributed in the second month, the revenue for a given filing period is distributed over a 2-month period, with any remainder pursued as accounts receivable in the future periods. However, the close of fiscal year 2025 revenues will include the full June 2025 filing period revenues. Which have been included in the department's forecast. So the full June 2025 period is included in the department's forecast, which explains why there are some differences in the forecasts before you today. So despite the department's best efforts to implement new processes as recommended with the vendor, there were several unanticipated challenges in processing, allocating, and distributing taxpayer payments at the outset of Phase 1. With each complication, the department has already launched processes to address them, and again, notably, some of these challenges are not new as a result of the Mint system, but rather indicative of the issues the department has always experienced with taxpayer errors in filing and reporting. The department has always had processes in place to address these types of concerns and have updated some of those processes. The challenges included in some of the forecasts today, which I will go over each one and address each one. We have unallocated funds, overpayment credits, and some delinquency. So unallocated funds, currently the following funds are received but need to be worked by staff in order to properly allocate and distribute the revenue. Non-targeted payments. So there are roughly around 900 payments or $6.38 million that these payments that have been made by taxpayers without any indication to the department what tax type they are attempting to pay. This portion of the unallocated monies has not been considered in the forecast, but we are aware we're working through all of those 900 payments as of the date that of the presentation was put together. So the forecast is not inclusive of these the $6.38 million, while the department works towards allocating these 900 payments to their appropriate tax types. The dollar amount is de minimis at less than a single % of the fiscal year 2025 major revenue forecasted by the department today. Overpayment credits. So overpayment credits, as of the date these figures were pulled just the other day, $22.97 million in the 6.85% total state sales tax is according to our general ledger. It does not show me the number of accounts, but these are payments that have been found to be taxpayer error by making a payment on a $0 return or an erroneous $0 return being filed with a payment, or applying payments to the wrong already paid period, or et cetera. There's various reasons, but those are the main two. And staff are working through these accounts and contacting and educating the taxpayers. These overpayments have been considered in the forecast before you today. So fiscal year 25 sales tax, of which $6.7 million has been added to the 2% portion. Modified business tax, there are also unallocated payments of roughly $10 million and roughly 2,500 filings, which were for mostly quarters 1 and 2 of fiscal year 2025. These were payments receipted in with an issue on the return that locked the payment, requiring the department employees to review. This amount has been allocated to the general business portion of the modified business tax forecast from the department based on data derived about these payments. Then the insurance premium tax as well has unallocated payments of roughly 8.9 million, or about 177 returns, so not to the extent of the modified business tax. And it's mostly from Q2 of fiscal year 2025. Like the modified business tax, these were payments receipted in with an issue that locked the payment, and employees must review. This amount has been considered as fiscal year 2025 forecasted revenue. The department has included the unallocated and overpayment revenues in the forecast, except for the non-targeted payments. The department's modernization efforts created a brief disruption of compliance activities, and toward the end of the second quarter of fiscal year 2025, which decreased the rate of collections at the same time as this accounting realignment. This has since been resolved. These factors contributed to temporary underperformance of actual revenue during those couple of months versus projections and variations in reporting for fiscal year 2025. Moreover, current economic conditions will be discussed shortly that explain the actual revenue differences. As collection activities have resumed, starting in the middle of the third quarter of fiscal year 2025, the rate of collections has returned to normal, and the department is focusing efforts on recovering accounts receivables regardless of filing period, including under collected periods from the end of calendar year 2024. Aligning with the department's continual goal of transparency to provide relevant and reliable information, these factors had to be discussed at this meeting today. Again, the revisions in the department's forecast from the December meeting totals are mainly due to economic conditions, but because we are simultaneously reviewing fiscal year-to-date totals, these discussions had to take place. And I am happy to answer any questions of this section of the presentation before our forecasts.
Thank you very much for that. Yes, you've been through a lot. I don't think.
Let me ask that.
Okay.
Now, when we have obviously estimates from you, from fiscal, and from the governor's office, are these numbers that you've just been talking about, would they in and of themselves cause a difference between the three estimates that are different than your estimate of general economic activity?
Mr. Levitt, Michael Nakamoto for the record. I think we can get more into that when we're actually doing the presentations on the sales tax. What I can tell you from the Fiscal Analysis Division's standpoint is we handled the distribution of mint differently than what Ms. Scott just put on the record, in that we did not believe that there would be an allocation of that last FY25 revenue into June. Our assumption had that posting in the first part of FY26, which, and Mr. Tower, when he comes and does our presentation, will talk more about that. But that, with a different understanding, that would cause an upward revision to our forecast in FY25.
Yeah, I noticed there's a fairly substantial difference in the current year, but then it narrows and much more in the next year.
Yeah. Mr. Levitt, Michael Nakamoto for the record. The difference in our forecast, and I cannot speak for Ms. Scott or Dr. Solorio, but our forecast handled this mint issue differently, and we will be prepared to discuss what the forecast would be given the move of the revenue from FY26 to FY25.
So with that, I think we're ready to proceed and walk through the major general fund revenue sources. So we will start with the state 2% sales tax.
And before I do that, before we do that, while everybody is getting set, Michael Nakamoto for the record, just for the members of the public, whether they're here or in Las Vegas or watching online, so that they can follow along with the meeting information, because we have put out several hundred pages of documents for this meeting. So the tables that are relevant to this agenda item are found under Agenda Item 10, which begins on page 243 of the Economic Forums packet. The first one is Table 1, and there are actually two versions of that. There's one inside the packet on page 243, and that is year-to-date collections for FY24 and FY25 through the end of March. We did update that this morning because we are now into May, and we have all the information through April 30th of FY24 and 25 to get you the latest and greatest information. That is outside the packet, and it is also in Nellis marked as year-to-date for Table 1 through April. Then on page 253 is Table 3, which has the forecasts by forecaster for the major and non-major revenues for each fiscal year. And this is for everything, both the majors and non-majors, as I noted. And then behind that on page 263 is Table 3 difference, which shows the change in the forecasts between the December and May, because I know that is one of the things that was requested by the chair. On page 269, Table 4 has a summary of the major revenue sources and the forecasts by forecaster, as well as the Economic Forum's December forecast, so you can look at the information there. Most of the discussion today and most of the information can be found on Table 8, which begins on page 273, as well as being outside the packet on green paper to make it easier for everyone to find who is in person. And that shows the forecasts for the major and some of the non-major revenue sources, including tax credits, by forecaster, and it also shows the changes from when we started in November to the December meeting to today, so you can see how the forecasts have moved over time. And then Table 9 is on page 281. That is also outside the packet, but that shows the growth rate that would be necessary based on the latest year-to-date collections for each forecaster to get to their forecast based on the year-to-date collections now compared to last year. So the version in Table 9 did not take into account the recent month of gaming and the live entertainment tax for gaming. But because we got that information the other day after we'd gone to print, we did a separate Table 9 outside the packet, so you have that information. And then there's other information on the consensus forecasts for the MBT and commerce tax, which we will talk about when we get to those. With that, I am going to yield. And turn it over to Ms. Scott so she can go through hers, and then Dr. Solorio can go through his presentation, and then Mr. Tower can come up and go through fiscals. Thank you.
Thank you. Linda Rosenthal for the record. Excuse me one moment, Ms. Scott. Before you start, I just broadly over all of these revenue forecasts, if you could please just focus your comments on what's changed since December, both in terms of assumptions, obviously in your forecasts and the forecasts themselves. I think that would be most helpful for us.
Thank you, Erica Scott, for the record. The slide shown here shows the forecast key assumptions made by the department and focusing on the differences from the December meeting. So the first note here, we have higher than expected inflation from the December meeting. So we forecasted that fiscal year 26 will be some of it felt at the tail end of FY25, mostly FY26, with inflation relatively slowing in fiscal year 27. So those would be the major differences in inflation, and then the sustained higher than expected lending rates in fiscal year 25 and 26, with some decreases in FY27. So mortgage rates, we're assuming, are going to maintain at a higher level than what we had forecasted in December. And wage growth, we assume it's going to be relatively sustained, but a slower growth rate in fiscal year 26. And also the housing supply remains tight, but the market's overall slowing due to the sustained higher mortgage interest rates. So just an overall slowing in growth in fiscal years 2025 and 26 from what the assumptions were in the last meeting in December. So next slide. So when it comes to the sales and use tax 2% rate, the revenues on the next slide, we look at the time series. So in the earlier comments discussing Mint implementation, that is where you would see that that not so lovely downward trend for that month. But then the revenue resumes. So we can see the November revenue impact during the cutover from the old tax system to the new Mint system. And while there was a rebound in the next month, the month-to-month comparisons are misleading because of the change to the cash accounting. Accordingly, the more accurate comparisons will look at a year-to-year comparisons going forward. And once we reach the December of 2025 receipts, accounting close in fiscal year 26, we'll have a more clear prior year comparison picture here. On the next slide, we have the department's 2% forecast that does anticipate slight decline in fiscal year 2025 to be $1.79 billion, then $1.80 billion for rather flat growth in fiscal year 26, and then some stabilization in growth in fiscal year 27 at $1.88 billion. This slowdown in fiscal year 25 and 26 from what we forecasted during the last forum is due to national policies at play, some slowing in tourism, while the inflation does attribute to the higher prices for sales tax, retail sold items, then the consumer spending slowing on those items is what we're looking at here. So on slide 8, we see this works out to a 0.2% decline in fiscal year 2025, then a 1% growth from fiscal year 25 to 26, and then a more stable 4.3% growth rate in fiscal year 2027. And I'm happy to answer any questions about this forecast before we move on to the other tax types.
Thank you, Madam Chair. Brian Gordon for the record. Thank you for the overview of the Mint system. I think I understood most of it. I guess I'll just ask a question that will maybe frame this up so that I'm thinking about the forecast that you've included here. When I think about 2025, the number that we've got on the screen here, is this 12 months worth of revenue?
Erica Scott for the record. Yes, it is.
Okay, so based on the earlier conversation with Mr. Nakamoto, you've sort of pulled forward some accrual accounting that may have fallen at the end of June 2025 and would leak into July of 2025. You sort of have accounted for that in your forecast and said, we're going to bring that back into the current fiscal year of 2025 so that we have what I'll call an apples to apples comparison. We've got 12 months of business-related activity. We've got 12 months of sales tax collection information. And when we look at that and compare that to 2024, on the whole, excluding any anomalies associated with the system conversions, we're looking at a decline of overall retail sales and use activity of about 0.2% for fiscal 25. Am I sort of recharacterizing what I think you just presented correctly?
Erica Scott for the record. Yes, that's correct.
Okay, and then in 2026, fiscal 2026, since you've pulled that July 2025 data into the current fiscal year. You've done a similar thing at the end of fiscal 26 to ensure there's another 12 months of equal sort of economic activity, at least from a timing standpoint. And based on that, it's now a modest 1% increase in the overall projection for that year, which is a lower rate of growth than where you were when we were sitting here in December. And then the same sort of seems to apply for fiscal 2027, if I'm thinking about it right. Is that all? Am I interpreting all of that correctly? Because I think Mr. Tower is going to have a little bit of a different take and probably has his, quote, pro forma adjustments that we're going to hear about. So I just wanted to make sure as we hear these, we're all thinking about it taking place exactly the same way. There's the reporting elements of it, but then there's also the reality of what's happening in the economy. So I just wanted to make sure I had that square in my head. So I appreciate you indulging me. Thank you.
Yes, Erica Scott, for the record, that is correct.
Linda Rosenthal, for the record. So this kind of goes without saying, but just to say it, the fiscal year ends end of June, right? So for your FY25 forecast, we're literally 2 months. We have actually, maybe that's not true. How many months of forecast data is in the FY25 number versus actual results? Actuals are booked through when?
Erica Scott, for the record. We have business activity reporting. Taxable sales would be acknowledged through the filing period of February of 2025. However, receipts have been split into the receipts we are about to close for this next revenue month. April's revenue month would be reflective of half of February and half of March filing period. Business activity period.
Okay, so you still have 5 months or so of forecast data in this forecast. It's not as simple as we're 2 months away from the end of the year. Great.
Correct.
And then I believe you said earlier the expected impact from the macroeconomic uncertainty that's going on in the world obviously is a bit reflected in FY25, but just because of time, see a bigger impact in 26, correct?
Erica Scott, for the record, that is correct.
Great. Thank you.
Thank you.
Other questions? Okay, we'll move on to Dr. Solorio. Good morning.
Good afternoon, members of the Economic Forum. I'm Dr. Mauricio Solorio Arteaga, and I'm the economist for the Governor's Finance Office. And I'm going to be presenting our May 2025 forecast for the upcoming biennium. Let me see. There you go. Okay, starting with sales tax. So what have changed since we last met? Pretty much everything. You know, we've seen what's going on in the economy right now. We now have tariff uncertainty that is dampening consumer and business confidence and spending. We have inflation expectations that now have risen. According to the Federal Reserve Bank of New York, short-term expectations have risen by 0.5. That now equates to 3.6%, while the long-term expectations remain anchored at 3%. We've seen that the Federal Reserve has not cut any interest rates. They're still holding their interest rate at 4.25 to 4.5. And any cuts on 2025 are quite unlikely to happen. I know Emily Mandel mentioned that they're forecasting 2 rate cuts, but that's pretty in the air. We've seen the conference that the chair has given that they do not know what they're going to do. Are they going to prioritize price stability, or they're going to prioritize unemployment? Tomorrow there is the unemployment data. On Wednesday they meet, so hopefully we're going to have a more certainty of what they're going to do with the interest rate. But as of right now, it doesn't seem that they're going to cut any interest rate in 2025. The labor market, we heard from Mr. Smith that we are expecting some sort of modest increase on unemployment, and most likely we're going to see the unemployment increase in logistics and shipment once the tariff starts to kick in. Now, the other one is international tourism. We're not expecting to see this massive decline in tourism to Las Vegas and to Reno. One of the things that I'm also considering here on my forecast, moving on my next slide, is that this decrease in tourism will be offset by a weaker dollar. So we're not going to see all that of a pessimistic forecast moving forward, because I do see that a weaker dollar will boost some sort of the international tourism from Europe. If you take a look at the conversion, €1 right now is 1.13. One pound is $1.3. So I do see that we're going to see some sort of a boost on tourism from Western European countries due to the weaker dollar. So that will help mitigate what's going on with Canada and Mexico. So that I have that included in my forecast. For my unemployment drivers, I'm foreseeing that in fiscal 26, the unemployment will rise to 6.5%, and then on FY27, it's going to decrease moderately. And then I use 2001 and 2002 historical unemployment records to kind of mimic what's going to happen in FY26 and FY27, since during those 2001, 2002, we did not see any sort of formal economic recession, but we saw a slowdown of economic growth, something that we might see moving forward. On tourism volume, my forecast of FY25 has a total state visitation of 44.3 million visitors, which is a downward revision of 2.43% compared to FY24. Statewide today, I took these numbers from the Las Vegas Convention and Visitor Authority and Reno Sparks Convention and Visitor Authority, so I put them together, and statewide year to date, we're down 1.8%. So I'm foreseeing that we're most likely going to close fiscal year 2025 at around 2.4% because of the geopolitical tensions. And then FY26, my forecast for tourism is $42.4 million, which is a decrease of 4.4% compared to FY25, because, you know, we're seeing that slowdown in Canadian and Mexican visitors, but I'm seeing that, you know, Western European countries are going to help us mitigate that gap that we're going to see. And then FY27, we're going to see some sort of recovery on tourism. Hopefully, we sorted out our issues with Canada and Mexico by that time, but we'll see. Then on inflation, my inflation expectation of 25 is that it's going to remain around 2.8. And then on FY26, once tariffs start to kick in, which we're expecting to kick in this summer, we're going to see an increase of inflation. Now, these numbers over here, they're really hard to put together, because if you look at any reports, you're going to find economists throwing numbers all over the place, from 3 to 5 to 6, you name it. So it was really hard. So I based it on expectations from the Federal Reserve Bank and on the idea that some of the tariffs are going to be dialed down. So we're not going to see massive increases in prices as we previously thought. So I have that hope. And then on FY27, we're going to see a moderate decrease in inflation. However, something to point out is that on FY25, I'm not seeing that the tariffs are going to go away. All I'm seeing that in FY26, once the tariffs starts to kick in, the price level is going to increase, and then we're going to be taking into consideration inflation from there. So the price from being calculated from $2 now is going to be calculated from $3. Okay, so prices are probably not going to go down if tariffs is still in place. Just the calculation of inflation is going to be from a different price point. Okay, so that's what I'm saying in FY27. Now moving forward on the next slide, I have a comparison of index growth or real sales tax versus nominal sales tax. And as we can see with the nominal sales tax, despite showing in the red dotted line, we've seen that the nominal sales tax have grown at a faster pace than real sales tax. And this is mainly due to inflation. If we take a look at the real sales tax, this real sales tax is anchored, is adjusted for inflation. So we are mitigating the price effects to see what is truly the economic activity. And we can see that the real sales tax is flat as it gets. The actual growth from Q3 of 2022 to Q3 of FY24, quarter to quarter, it's been 0.2%. This indicates that Nevadan households and tourists are probably buying the same amount of goods, they only paying higher prices for it, which is a little bit concerning given the fact that both of them need to move together in order to see some real, true economic change. Now, moving forward to my second slide, here I'm comparing the year-over-year change in inflation with the year-over-year of real sales tax and nominal growth. So one of the things that I wanted to point out on this graph, and let me see if I can draw on this. Let me see, what is the mouse? Could I draw it or no? It's not going to work? Or are we seeing the drawings or no? And the yes, you see it? Okay, I think it's working. Yeah, I think it works. Let me see. So if we take a look at the first portion of the graph, this is what the Federal Reserve Bank is trying to do. So this is something that we call price stability. So as inflation is very stable at 2%, we see that our nominal and real sales tax are really close to one another. Okay, so in this scenario, we don't really care which one we forecast because it's pretty much the same number. Okay, so that's why the Federal Reserve Bank is always trying to keep that inflation very stable, so it produces price stability, so we don't have to worry about nominal or real because it's the same. But once the inflation starts to grow, let me see, where is that little point? There you go. So once inflation starts to grow, we see that the nominal and sales tax, the nominal and real sales taxes start to separate from one another, and that's it causes a lot of issues. And then when we see on the here on Q1 of FY23, this is when we saw the biggest inflation number that during the post-pandemic era. This is where we hit around 9% of inflation. We can see that the nominal and sales tax are completely away from one another. And then once the inflation starts to come down, we see that inflation hasn't gone back to pre-pandemic levels. And that's what is pushing the real and nominal sales tax to go down because inflation hasn't come down to pre-pandemic levels, something that we see in this graph. Now, moving forward on my next slide, let me see. Sorry for the horrible drawings. Okay, there you go. Now on the next slides, we're seeing the effects that unemployment and tourism are having on real and nominal sales tax. One of the things to point out on this graph is what's happening on Q4 of FY21. So in Q4 of FY21, this is where we're seeing the unemployment number that starts to increase, and our tourism numbers start to decelerate. So the growth is started to contract, while the unemployment rate starts to go up. Or nominal sales tax and or real sales tax starts to go down as well. It's like if unemployment is pushing, it's like if unemployment and tourism are squeezing the nominal and real sales tax. It's a very fascinating graph. When I was looking at it, I'm like, wow, this is very interesting. So that's why my model is taking in, okay. Yeah, all right. And this is my longest presentation. My other ones are very short. Okay, so now that's why my model, I went ahead and calculated, I forecasted real sales tax given that inflation is on the air. It's an extremely difficult thing to try to forecast what's going to happen with inflation due to the tariffs. So I went ahead and calculated real sales tax based on my unemployment and tourism data. And my forecast brings my real sales tax down from FY24 to FY25 to negative 2.9%, which is $1.3 billion, and then FY26, negative 1.12%, which is $1.36 billion, and then on fiscal year 27, it's a moderate increase of 0.93%, which equates to $1.37 billion. Now, when I convert this back to nominal sales tax, given my inflation forecast, given my inflation expectations, my nominal sales tax now for FY25 is a decrease of 0.1%, which equates to $1.79 billion. The actual number is on your green sheets. It's 1.788, but just rounding it is just 1.79. FY26 is I'm forecasting a growth of 1.9%, which equates to $1.82 billion. And then of FY27, I'm forecasting a growth of 3.5%, which equates to $1.89 billion. And then on my last slide, I have used a comparison between the two, the real and nominal sales tax. And just to point out, if you take a look at 2020 and 2021, that's when we have really stable inflation before the pandemic. So you see that the nominal and real sales tax are really close to one another. But once inflation starts to grow, that's when we start to see that gap between the real sales tax and the nominal sales tax. And what I have here is the inflation rates in my graph. So as you can see, I have my inflation expectations on 26 of 3.15 and my inflation expectation of 2027 of 2.5% of inflation. And with that, I'm happy to answer any questions. Oh, sorry, I did not change the graph. That's the one.
Thank you, Dr. Solario. I don't see any questions. So now we'll move over to Mr. Tower.
Thank you, Chair Rosenthal. Christian Tower with the Fiscal Analysis Division for the record. Economic Forum members will find fiscal state 2% sales and use tax forecast in the Fiscal Analysis Division forecast information package from page 55 on. The May 2025 forecast of the Fiscal Analysis Division projects lower state 2% sales tax collections over the 25 to 27 biennium than our December 24 forecast. It is also lower than the December 2024 Economic Forum forecast, and we project a drop in revenues of approximately 5% between fiscal year 2024 and fiscal year 2025. And I will now try to explain how we got to that by focusing on three main differences between our May 2025 forecast and our December forecast. And the first one relates to the presentation of Ms. Scott on Project Mint. That's our first big difference. We accounted for the implementation and the change in reporting periods of Project Mint, and we were under a different understanding of how that will be handled. And we assumed that the state of Nevada would only be able to collect 11.5 months of taxes in fiscal year 2025. And this 2 weeks of tax collections missing in July would actually account for, in our forecast, $75.3 million. So these $75.3 million in our forecast, and when you look at Table 8, the green table on the green paper, you see that our forecast is in fiscal year 2025, $101,645,000. Below our forecast in December, and $75.3 million are entirely accounted for by our assumptions with respect to Project Mint. Now, there's a remaining difference as well between our December and May forecast, and I'll come to this now. There are two more differences in our forecast in May than when compared to December, and the other one concerns our argument on consumer spending realignment. In December, we were making the point that increasingly, when we were looking at actual tax collection data for July and August, we saw year-over-year decreases in sales tax collections. And I explained back then that our understanding is that this has something to do with the realignment of consumer behavior, consumer spending going more into areas that are not taxable, at least by the sales tax, such as insurance premiums, rents, or groceries, which under Nevada law do not attach to the sales and use tax. So that is a behavior we saw. And the difference to our December forecast is probably that we now see that this period of realignment of consumer spending behavior will take longer than we thought. In December, we thought it would be pretty short-lived. And now we see this continuing in fiscal year 2025 all the way into fiscal year 2026. And that accounts for a general somewhat more pessimistic projections concerning sales tax collections. Finally, the third aspect where we differ from our December forecast is our general economic outlook. the general uncertainty, decreasing visitor volumes to Las Vegas, and the general uncertainty with concerning to jobs and which will have an impact on consumer spending. So combined, these differences between our December 2024 and May 2025 forecast account for a decline in state and use tax revenues by 5% in fiscal year 2025 in fiscal year 2025, $1,701 million. If I take Mint out, so the $75.3 million out, the difference to our December forecast goes down to approximately $26,300,000. So that is a difference number if we account for what Ms. Scott presented, how the Department of Taxation plans to handle the shift to Mint. If we adjust our forecast to that, we are basically we are projecting lower revenues of approximately $26,300,000 in fiscal year 2025. For fiscal year 2026, we do not need to have an adjustment there because our accounting for Mint would only concern fiscal year 2025. So in fiscal year 2026, we forecast that sales and use tax revenues will increase by 6.6% to $1,840 million. But note, however, that if we take out the Mint correction in fiscal year 2025, that increase is much smaller. It goes down to 2.1%. So without Mint, the increase in fiscal year 2026 we project for the sales tax collection is 2.1%. For fiscal year 2027, we project that sales tax revenue increases by 3.3% to approximately $1,874 million. Thank you.
Michael Crone for the record. So I understand now there's basically a $26 million difference if we account for the Mint system. And you talked about those kind of two factors, the other two factors not related to Mint. How does that $26 million break down between those two factors?
So it's a little bit different. So Mint accounts for $75.3 million.
Right.
Remaining is at the $26.6 million. And so these other two factors, the longer period of realignment plus the difference in economic outlook account for the $26.6 million when compared to the December forecast.
Right. So my question is, for those two factors, how do you break down that 26? Which one of those two influences it more?
In the nearer term, it's the realignment, and in the longer term, it's the economic outlook. So the realignment really allows us to see how the trend of sales tax collection, which we see in the actual data, how that will project over the coming months. Yeah. And from there on, we basically, in our normal models, how we run them, we are really dependent on the economic outlook. Employment, visitors, inflation, and all that, and how that plays out, and how that affects the taxable sales and accordingly the collections of sales and use taxes.
Okay, thanks.
Thank you, Madam Chair. Brian Gordon for the record. Thank you for the presentation. Just so I understand it, this was the pro forma adjustment that I was sort of referring to before. You've pulled those 2 weeks of July collections into June. You did mention, though, that it doesn't change the absolute amount of collections in fiscal 26 and 27. Is that just because once that adjustment is made, it's just a rolling 12 months, and so you didn't need to make an adjustment? I just want to make sure I've got that right.
That is exactly correct. So that was our assumption, that once the switch is made, these 2 weeks acceleration of collections and reporting, that will then continue, and that in 2025 we take the hit, and from there on we have 12 months, but on a different reporting and collection basis. Yes.
Okay, and then just one step further, if I'm looking at Table 8 and I'm looking at the differences between the December and the current forecast, if somebody were to look at these additively or cumulatively across the table as they're presented, we've got $75 million worth of overstated adjustments if we didn't make this sort of pro forma adjustment. Just on the surface, I guess if somebody's focused in on this particular schedule, if we added the $101 million delta for fiscal 25, the $55 million in 26, and the $81 million adjustment to the forecast in 27, adding all of that together is a little bit of an overstatement of the adjustment, because we haven't sort of accounted for this $75 million of accounting related activity. Is that fair?
I'm wondering whether I fully understood your question.
And I didn't say it very well, so maybe I'll say it differently. And I'll probably end up saying it exactly the same way, so I'm sorry for this. But I think the public in general and all of us sitting on this board feel like we want to understand how projections have adjusted from where we were in December to where we're at today. And in my mind, I start to look at the differences between the projections and say, there's a lowered expectation, and you've all have outlined that fairly well, why we're seeing that. But if I were to say, what is going to be the impact on the state's coffers, adding these across the differences cumulatively is not a fair thing to do. I'm just wanting to make it clear that that wouldn't be the right way to look at this schedule, because there was this anomaly that wasn't, I don't want to say wasn't reflected, but was just treated differently. Is that reasonable?
Correctly, absolutely correct. And it concerns mainly the 101 million you see in fiscal year 2025. That would actually have to be reduced by $75.3 million.
And this would be the $26 million difference.
Exactly, that would be the $26.3 million difference instead of that 101 million. Yes.
Perfect. I just wanted to make sure we had that straight. Thank you.
If there are no other questions, we could entertain a motion on the forecast for the state 2% sales tax.
So moved.
We need you to actually make a motion with which forecast or our own forecast we would like to consider.
And looking at all of and trying to kind of wade through all the different changes that we have here, I tend to be more conservative in our forecast, given all the presentations that we have. And just listening to the presentations, I think I tend to lean towards somewhere around what the fiscal division is coming in at for the forecast. I'm not very optimistic on the way things are going to look for fiscal year 2025. Perhaps a little bit more optimistic in 2026, but given they came in kind of toward the middle in fiscal 2026, I'd make a motion to adopt the fiscal division forecast for our sales tax.
Thank you. So before we do a second on that, I think we need to quantify the fiscal's 25 forecast with the adjustment for the adjustment to the system. So by my math, it would be $1,776.5 million in FY25.
Going on.
Is that correct?
Yeah.
Mr. Jack.
That is correct. That's also my math. I have $1,776,556,000 for fiscal year 2025.
Great.
So point being, it's still the lowest, the most conservative of the estimates. That's the point I was trying to.
Yeah, absolutely. I was just trying to get a number on the record so they could do
sorry.
the math. Okay, so with that number for fiscal's forecast for FY25 and then the stated numbers here on the sheet for FY26 and FY27, that's the motion on the table. Do we have a second?
Madam Chair, can I just ask one question of staff here? It may be helpful to understand, and I don't know that you can do this on the fly, but understanding what I'll back up. I believe at the December meeting, we had selected the agency forecast. Before we vote, just for my clarification, are we able to see what the difference would be between where we were at in December versus where we're at today? As we switch to an alternative recommended forecast. And if it's not possible, that's fine. I think we're all generally comfortable with where we're headed. I just, maybe knowing what that looks like would be helpful.
Mr. Gordon, just to clarify, would you like to know the difference between the December Economic Forum forecast and fiscals, or the one that is on the motion?
Yes, I guess we previously had agency forecast as the baseline in the December forecast. Now we're suggesting moving to the fiscal. Those differences between the December and May 1 forecast just aren't plainly stated on the schedule, so I was just curious.
So according to my calculation, the difference between the Economic Forum December forecast that the Economic Forum decided on and this forecast is for fiscal year 2025 approximately $16.6 million. Downward revision. For fiscal year 2026, approximately $51.4 million. And in fiscal year 2027, approximately $51.1 million. All downward revisions.
Okay, that's helpful. And the $60 million in fiscal 25 does account for the $75 million we talked about?
No, I took them out, and it's 16, and I apologize if that came across differently. $16.6 million.
That makes more sense to me.
Yes.
Thank you very much. I appreciate that.
And that accounts for I put back what I took out for Mint, basically, for this.
With that, I would second that motion.
All in favor?
Aye.
Aye.
All opposed? Motion carries. Are we clear?
Yeah, I think we're good, Madam Chair. Just Michael Nakamoto for the record, and just for the information for Mr. Gordon and the rest of the members of the committee. When we come back and finalize the forecast, we will have a table that will show the differences between the December and the May forecast for all of the major revenues as well as the non-majors and the tax credits and everything else. So you'll be able to, it will be clearly spelled out how all of the forecasts are changing at the end.
Great. So next up would be the live entertainment tax. I would propose we do non-gaming first, just so the logistics of people sitting at the witness table are a little easier. So whenever you're ready, Ms. Scott, we can do non-gaming live entertainment tax.
Thank you. Erica Scott for the record. For live entertainment tax non-gaming, first we look at the time series for the live entertainment tax, similar to sales tax. Is it showing? There we go. It shows the decrease in October and November due to the timing of the cutover to the new system. However, there was a large rebound in the December filing period. This tax type is still maintaining an average monthly revenue of $8.7 million, and even accounting for the low October and November months. So that average monthly revenue from this tax type is continuing fairly strong. On the next slide, this revenue, we are forecasting a decline in fiscal year 2025, all well knowing that this is not for lack of demand in shows, but mainly due to the fiscal year not being able to compete with last fiscal year with hosting Super Bowl and the inaugural Formula One race. The state continues to fill the calendar with performances in the stadiums, however, and with events, which is why the forecast is still well above prior years at fiscal year 23 and any prior year before that. So ultimately, this is still a growing tax revenue. The calculations into this is basically the demand for these shows. We're seeing domestic tourism maintained in continuing to attend these shows. I know there's been a lot of talk about a decrease in tourism from international guests to the city of Las Vegas, which is where most of these shows are occurring. But we are forecasting for steady growth, albeit a little slightly less aggressive as the December forecasts. So for fiscal year 25, we forecasted at 104 million, fiscal year 26 at 106 million, and fiscal year 27 at 109 million. On the next slide, we can see the differences of, so that fiscal year 25 is a decrease of 19.3%, but then the growth of 1.7% in fiscal year 26 and more significant growth of 2.5% in fiscal year 27. While this, as I had stated earlier, this tax type is also subject to tourism impacts, but the demand of shows for domestic tourists and locals does not seem to indicate as much slowing in consumer spending as on retail. So with that, it's simple. I'm happy to answer any questions.
Thank you very much.
Thank you.
Dr. Solario?
For my live entertainment tax, non-gaming, my previous assumptions still hold. We have a capacity constraint. You know, we still have F1 in the future. Average tickets, they're still pretty high. One of the things that I added for this forecast, it's the resiliency of live entertainment. So when I was doing some of my research, I found out that there is an emotional value attached to these concerts. And given a survey that I found on Soundbite magazine, they said that 86 to 90% of their surveyors found out that people will still go to concerts despite economic downturns. And according to Business Insider, we've seen that live music spending has historically grown during recessions, which is quite fascinating. And then on top of that, you add that just on the one of the biggest concerts of the year, Coachella, 60% of the participants finance their tickets. So this is something that we might see moving forward, even if tickets are still $1,000. People will find a way to finance those $1,000 tickets. So live entertainment tax might be a recession-proof type of revenue, as well as liquor tax that we see during recession. People like to drink their sorrows away. People might like to sing their sorrows away in live entertainment tax. With that in mind, my forecast for FY25, I'm forecasting a decrease of 16.2% to $108.3 million from fiscal year 24. And then I'm forecasting a moderate growth to 2.04% of fiscal year 26, which equates to $110.5 million. And then on 2027, I'm forecasting a growth of 3.42%. which equates to $114.3 million. Thank you.
Thank you very much. Mr. Tower?
Thank you, Chair Rosenthal. Christian Tower for the record with the Fiscal Analysis Division. Turning to the non-gaming live entertainment tax, if you look at Table 8 in front of you, you see two things. First of all, our forecast is lower for fiscal year 2025 than for the actuals came in for fiscal year 2024. And that is because fiscal year 2024 was such an exceptional reference year, for the first time Formula One with the Super Bowl and all that. What you also see, and when you look at fiscal year 2025 in Table 8, is that we made a slight upward revision for our forecast. And that has something to do with the way we see the tax moves. We see the big stadium events, the concert in the Allegiant Stadium, in the T-Mobile Arena, in the Sphere, they seem to be more frequent and for higher ticket prices than ever before. At the same time, there are certain segments in that tax that seem to be moving down. Festivals don't work anymore that well. 2 big festivals have actually been canceled in fiscal year 2025. Also, the second time around, Formula One seems to have been less of a revenue maker than we projected. Finally, there were some exceptional events as well. Was it last weekend or the weekend before, WrestleMania took place? And we believe from news articles that this was probably something that would fall under the LET non-gaming. And the tickets sold for incredibly high amount of money. And so we factored that in as well. So we see 2 moving directions: stadium events, big ticket events, stronger than ever. And that accounts for our upward revision of the forecast. Whereas in other areas, the tax is actually losing out, festivals and this year probably in the Formula One. And that accounts for our fiscal year 2024 forecast of $108,715,000 in LET non-gaming tax revenues. So that means a decline in revenues when compared with the exceptional fiscal year 2024 of 15.9%. At the same time, as just explained, it means an upward revision to our December forecast. For fiscal year 2026, we project $107,707,000 in revenues, a decrease of 0.9% when compared with fiscal year 2025. And that decrease is mainly due to our expectation of slightly fewer big-ticket events in fiscal year 2026 when compared with fiscal year 2025, and generally declining or stagnating visitor numbers in Las Vegas. And the slightly declining big tickets event is also this WrestleMania event I was citing, which we believe, according to news articles, that has generated potentially LET revenues that we have no knowledge that this event will repeat itself in fiscal year 2026, so we took that out again. For fiscal year 2027, we forecast approximately $109,025,000 in non-gaming live entertainment tax revenues, a moderate increase of 1.2%. Note that, as in December, we take into account that the contract between the Formula One and the Las Vegas Convention and Visitor Authority schedules annual Formula One races until the end of calendar 2025 only. And as in December, we factored the uncertainty regarding this event into our forecast for fiscal year 2027 by cutting the anticipated revenue generated by the Formula One race in half. Now, the effect of factoring this uncertainty in is, however, at least partially canceled out by us also taking into account that in January of 2027, the College Football Playoff National Championship will take place in Las Vegas and will, according to our estimation, be a major revenue source in that fiscal year. And that explains how we came to fiscal year 2027, despite factoring in the Formula One's uncertainty with a slight increase. Thank you.
Thank you, Madam Chair. Brian Gordon for the record. Thank you, Mr. Tower. We just had this long discussion about the collection and the mint system and sales and use tax. Does that impact non-gaming LET at all? Was that included in the system conversion?
So we have not included that here. So for the live entertainment tax, there's no deduction for Mint, if you want to call it that way. It's a non-factor in our fiscal analysis division forecast. Yes.
Great, thank you.
You know, looking at the numbers, everybody is pretty close to where we were in December. So I'm going to make a motion we keep our December numbers for the non-gaming live entertainment tax.
I'll go ahead and second that motion because that's kind of where I was as well. We were fairly conservative, and I think with the consumer confidence issue, I think that staying conservative is the right approach.
I'll just ask one clarifying before we hear further on the motion. How do we want to deal with fiscal 25? I think we, based on where we were at on the non-gaming LET, are we tracking ahead of that now that we have additional insight, or just accept where we were before?
My feeling is that we're looking at essentially the same thing as agencies is projecting for the 2025 year, which is the same as what our projection was. Very close. If you look at, they're projecting 104,290. We projected 104,276. So if we keep that, we're essentially the same as agencies projecting for the current year. So I just thought, well, maybe the best thing just to use our own projections for the prior year.
Erica Scott, for the record, I can kind of clarify why the any timing of that particular tax type may not be relevant to any issues with the Mint system, because the tax is due upon the ticket sales. So we're already, it's based in the timing of the sales of the tickets anyway. So there's already some fluctuation built into that tax type that does not seem to be, we're closing out fiscal year in the hottest time of the year, where maybe some of those events may not be taking as much place in that time of the calendar. So if that assists in answering that question.
Michael Chrome, so were you just asking Brian or Mr. Gordon, where we're trending currently with this LET non-gaming? And is it trending toward this 104? Is that your question?
Yeah, I was just suggesting it sounded like there was more optimism among some of the forecasters as it relates to the current period. But again, it's probably de minimis amount in the big scheme of things, but I just wanted to make sure we were thinking about the trend line correctly.
Yeah, I had a similar question as well. If this is the trend that we're on right now for the LET non-gaming, then
Dr. Soler, for the record, I actually have that number here. So fiscal year today, we're down 5.8% on live entertainment tax non-gaming from prior year.
Sorry, what was the percent again?
5.8.
And what is that number? What is the year to date?
That is $61.2 million in fiscal year 25.
How many months is that?
7 months. 7 months. And then on FY24, the same year to date, we were up we were at $65.03 million.
Okay. And my other question, going way back to the memo that that you produced about the Mint system, there's this $6.38 million in non-targeted payments. Is it possible that some of that is related to some of these categories that we're talking about here, or am I missing something?
Erica Scott, for the record, there is a possibility. However, the good majority of receipts that the department receives are from sales tax, sales and use tax. That's the most amount of taxpayers that we have, and it's the largest amount of receipts that we receive.
So it's likely in that category, but you
Correct.
can't guarantee it. Okay,
Correct.
I understand.
So just a little, Linda Rosenthal for the record, just a little more discussion before we consider the motion again and vote. I mean, if you take the actual collections year to date and you just annualize it, we're right around that 104. So unless there was something that led us to believe in the next few months that number's going significantly higher, it seems like agency or our original forecast is in line with what's expected for this year. This is the one tax, I know there are not big differences here in the forecast, but this is one tax where I personally would feel more comfortable with a little bit higher forecast. I mean, like domestic travel's great, people buy these tickets. I mean, these are entertainment events that people are going to spend the money to enjoy, whether they're suffering financially or not. Having said that, so I would be comfortable going higher, but having said that, I'm also comfortable with where we were at the last forecast, because I do believe it's a time to be prudent. I just think this is one of those taxes where we might not see the consumer impact as greatly. So that was a lot of discussion. Do we want to restate the motion and then vote? Marvin, would you mind restating the motion?
Yeah, from the December.
Do we have a second or more discussion?
I'm happy to go ahead and second again.
All in favor?
Aye.
Aye.
All opposed?
Aye.
Okay, that motion carries. Thank you very much. Next, we'll move on to LET Gaming. Not sure who the first, well, Ms. Knoll, will that be you? Welcome. Whenever you're ready.
Good afternoon, Chair Rosenthal and members of the Economic Forum. For the record, Shelley Newell, Senior Economic Analyst for the Nevada Gaming Control Board. For our live entertainment, we have made revisions to the forecasts presented back in December 2024. Some of the facts have not changed, such as the Mirage closure and its reopening as a Hard Rock is intended and expected to still be in the next biennium, not this one. Tropicana, that fact has not changed. The primary drivers for the changes for this forecast were the actual data and the information that we have to date and the discussions that we've been having with our licensees. The numbers that were presented back in December took us through October of 2024. Our numbers bring us through March of 2024. So with that said, our prior forecasts, which you can see on the table there, we had the 117.2 million, 113.7 million, and 114.8 million for fiscal years 25, 26, 27, respectively. With this new forecast, we have brought those numbers down to 112.4 million, which is a 4.9 million decrease approximately. We have the 112.8 million forecasted for fiscal year 26, bringing that down approximately 900,000. And for fiscal year 27, we brought the number down to 113.9 million, which again is approximately 900,000. Again, the driving factor was the data that we had to date. Right now, fiscal year to date, for fiscal year 24, we had 95 million. Fiscal year 25, we're currently at collections of 84.2 million. That has us down 10.8 million, which is an 11.42% decrease from our forecasted numbers. In having discussions with our licensees, because again, we wanted to know if it was that they weren't filling the seats versus was it price point, a combination. They've been expressing that it was they were filling their seats and that it was more driven by price point. And their goal is always to find that headliner and not because the seats are not being filled. So taking that information into consideration, while we did bring those numbers down, we begin to bring those back up. So we have the or the 112.4 million, the 112.8 million, the 113.9. But again, we continue to bring that back because our licensees are cognizant of what's happening on their properties. Entertainment also drives their gaming numbers. They're always looking to drive both simultaneously. With the confidence that we have in them and knowing them, and as the numbers are coming in, I recently looked at some March tax returns. We had some outliers that kind of stood out, some increased numbers. So again, I know they're cognizant, I know they're trying. And with that said, the forecast that we have before you is the recommended forecast. And I'd be happy to answer any questions that you might have.
Thank you. Thank you for your presentation. Dr. Solorio?
Dr. Soler, for the record. So our laptop is not working, so we're gonna go with it just by ear. For the live entertainment tax, gaming, my prior assumptions, they still hold. We're still gonna see a decline in the gaming live entertainment due to the rise of competition of the non-gaming live entertainment. An additional assumption that I added this time is a slowing tourism will further decrease this revenue tax because of, you have fewer people going in, and then you have to compete with the bigger events. So that's why I'm revising it down the way I did. For my fiscal year 2025, I'm forecasting a decrease of 11.8%, which equates to $112.9 million. For FY26 is also declining at 1.92%, which equates to $110.8 million. And for fiscal year 2027 is still going down as the competition from the live entertainment tax kicks in at 1.9%, which equates to $108.6 million. Thank you.
Linda Rosenthal for the record. So my pause here is on the continued decline year over year, even with, FY27 being the lowest year, even though at that point in time we feel like some of these pressures we're having on a macroeconomic level are subsided. I know you stated it was competition from non-gaming venues. I guess I just questioned that logic a little bit. If tourism is back and the gaming properties are having venues and entertainment options, just for the record, I personally would see this grow year over year, maybe at a slow rate, but I wouldn't see a decline in this tax personally. Any other comments you want to make in regard to that trend?
Yes, Dr. Soler, for the record. So one of the things that I had it still going down on 27, it's because of the kind of pressure that I'm foreseeing from the households and the tourism coming in, because if things go kind of south in FY26, we're going to see people be more conscious with their money. So if they're coming to Vegas for a $1,000 concert, they might not have that spare $100 ticket to go and watch a magic show at the MGM. So I do foresee that, I'm already bought this $600 ticket for the football game. Should I spend another $150 on another show in a casino? So that's why I'm seeing that that people are going to have that trade-off going on in FY27.
Thank you. Thank you very much. Mr. Tower?
Thank you, Christian Tower, Fiscal Analysis Division, for the record. Most of our December assumptions also still hold, so we took into account the closure of the Mirage. We took into account that fiscal year 2025 is up against a very strong reference year. And we took also into account that we believe there is a change in consumer behavior. More and more visitors to Las Vegas book their concert tickets or their tickets for the Sphere first and then book the rest of their Vegas trip around it. And that may lead to overall a little bit of competition between outside of casinos live entertainment and within casino live entertainment. So that just in order to preempt also your question, the question you asked Dr. Solorio, that is why that explains our numbers to some extent in fiscal year 2025. However, we do see slight growth in fiscal year 26 and 27 because we believe that this LET will basically fall down from the very strong reference year and then on a very slow, embark on a slow growth path. What is important and what the difference to December is probably our general outlook that has changed, in particular in terms of visitors. We project visitors to basically be stagnant in fiscal year 2026, a slight decrease in fiscal year 2025, the year before, when compared to fiscal year 2024. And in 2027, we think that visitors will start coming back on a slow growth path. And if we drive all that through our forecast, that means that in fiscal year 2025, we fall down from fiscal year 2024 by 10%, and then we grow by 1.3% in 2026 and 27. So resulting in a forecast for fiscal year 2025 of $114,322,000. In fiscal year 2026, we project gaming live entertainment tax to moderately grow by 1.3% to $150,767,000. And for fiscal year 2027, we forecast continued moderate growth of 1.4%, resulting in $117,360,000 in tax revenues. Thank you.
Dr. Solorio made a couple of, Michael Crone for the record, a couple of points about this trade-off between the gaming and non-gaming. So I guess for the two of you from the agency and fiscal, do you factor that in to your analysis? Do you think that trade-off actually happens where we're seeing a shift, or is that already built into prior years because this non-gaming piece has been, pretty prevalent for a while now? So I just want to know how you think about those two things. And then the second point that he made about if you see growth coming back in 26, 27, are you going to have to make that trade-off? You can't buy two shows, you're only buying one. I just want to know how you both thought about that in your approach.
Thank you for the question, Christian Tauer, for the record. So yes, we factored that in. And so that is why for our LET non-gaming, we have actually, in comparison to our December forecast, some growth. And then actually if we take the WrestleMania out and everything, we have growth from there on, whereas LET falls a little bit on a lower level. But we still think, once the mirage has been absorbed and the casinos figure out how to fill the hole that has been created there, that there will be a slow growth path. I mean, if you look at the numbers, yes, the gaming part of the LET has been declining somewhat, but overall, there's still a lot of entertainment going on, and we believe that this is not something that's going to go away. But there's a market correction happening with this consumer orientation that has changed a little bit maybe, but then we believe that from that correction on, there will be growth again. And the reason why we factored that in more in fiscal year 2025 is really because in fiscal year 2025, to be honest, to my own surprise, it seems to me that these stadium events are just doing so incredibly well in Las Vegas.
For the record, Shelley Newell with the Gaming Control Board. Yes, when we were looking at our revenue projections and the LET tax, we did factor in whether people would transition between the gaming over to the non-gaming side. That was factored in. We also have been thinking about, the economy, the talk of our nation. And with this forecast here, we have also factored that in. Again, we often find that when people want to go see an entertainer, they're going to want to go see an entertainer, and they will still pay that price for that entertainer. So again, keeping those things in mind, those elements were factored in when we came up with our forecast.
I'm a little bit concerned about increasing the number from our December forecast when the news that we've received since December is not particularly good as to the economy. For that, I personally think we ought to go with agency for all 3 years. I'll make a motion to that effect.
Sorry, but I was kind of leaning that direction as well with the agency forecast, so I'll go ahead and second that motion.
Any discussion? All in favor?
Aye.
Aye.
All opposed? Motion carries. Next, we'll move on to the gaming percentage fee tax. So no rush, but when you're ready, Ms. Newell.
And while we're transitioning, Madam Chair, for the record, Michael Nakamoto with the Fiscal Analysis Division, we're having technical issues with the laptop that would take time to resolve that I think, frankly, in the interest of time, we don't have. So we're going to go without the laptop, which we apologize to the people who may be watching this online. But again, the meeting materials are available in Nellis. Thank you.
Again, Shelley Newell with the Gaming Control Board for the record. We have made revisions to the forecasts that were presented back in December 2024 for the fiscal year 25, fiscal year 26, and fiscal year 27 for the percent fees. The primary drivers of those changes are the actual numbers and the additional data that we have since the last meeting back in December. For statewide total win, the figures were adjusted slightly upward, and the figures were adjusted slightly downward in game and table win, which together combined led to the forecast being presented today. So as we move on to our first graph that we had, this was one of the original slides from the presentation made back in December 2024. At the December 2024 meeting, the statewide total gaming win forecast were based on data through October 2024's numbers, and that is what led to that forecast. We now have the March numbers that have been released, and so our forecast has been updated to reflect the data up through March revenue numbers. Again, I included it here for reference purposes in case you needed to go back to it. So moving on to our next slide. What we have presented here is the statewide total win. It takes us from June all the way up through February 2025. At the time of the PowerPoint, I didn't have the March numbers, but I do have the March numbers. We released them a couple days ago. March came in at $1.276 billion in total win. March 2025 also made for a moderate to difficult comparison to March 2024, as March 2024 fell behind the Super Bowl month. In addition, for March 2025, we had one less weekend day because our day fell on a Monday. When it falls on a weekend, that obviously is where we see the spike in revenue. Despite those factors, March's total win was only down 1.1%, or $14.3 million when compared to March 2024. With the release of the March numbers, we can say this is the 49th consecutive month that total gaming win has hit over $1 billion. Similar to the narrative in December, total win has been a single-digit increase or decrease with the exception of January 2025, which resulted in double-digit increase of 12.6% in total win compared to January 2024. If we move on to our next slide, what I have presented here was, you see the original actual numbers for total win for fiscal year 2022, 23, and 24. Those are the blue bars on the graph. Then the next forecast, the next three bars, were the figures forecasted in December 2024. The last three are the newly forecasted win figures for fiscal year 25, 26, and 27 for the total win. Again, the updated forecasted figures are based on the data that we have to date, with those changes being made to the slot side and the game and table side. The minor percent changes that you see there are the differences between the new forecast to old forecast. If we move on to our next slide, kind of take a little bit closer look, For fiscal year 25, the newly forecasted total win amount was adjusted up by approximately $8 million, or an increase of 0.5%. For fiscal year 26, the newly forecasted total win amount was adjusted downward approximately $25 million, for a decrease of 0.16%. For fiscal year 27, the forecasted total win amount was adjusted downward by approximately $16 million, or a decrease of 0.1%. Again, I think it's important to note this is just a comparison of the two forecasts, but they are small decreases. And again, I think that's important as we evaluate what wins should be and what our forecast should be. The forecast changes, again, come primarily as a result of our actual figures to date, which take us through March, discussions that I've had with our licensees, and based on the historical data that we have both in slots and gaming tables. We evaluated all of those factors as we worked through what the total win numbers should be. If we move on to our next slide. On the next chart, we have the updated statewide slot win forecast for fiscal years 25, 26, and 27. This changes as a result of the data that we now have to date. The new forecast figure shows a 1.71% increase to slot win for fiscal year 25, increase of 0.48% to slot win for fiscal year 26, and an increase of 1.21% to slot win for fiscal year 27. The forecast in December 2024 showed $10.48 billion, $10.54 billion, $10.67 billion in slot win for fiscal years 25, 26, 27 respectively. The percentage change between the December forecast and the new forecast is an increase of 0.51% to slot win for fiscal year 25, an increase of 0.32% for fiscal year 26, and an increase of 0.39% for fiscal year 27. On the next slide, I can kind of dive into what some of those factors are in terms of slot win that drove us to modify those numbers. On our statewide slot win chart that we have there, slot win takes us through February 2025. Again, it's a timing thing. March did come out. Our March 2025 slot win came in at $918 million, which is up 5.05% year over year, or $44.1 million when compared to the March 2024. Slot win, when compared to pre-pandemic levels, is up 36.1%, and overall has continued to steadily grow post-pandemic. We continue to see slight increases in slot volume, which is an indicator of increased play. Slot count totals remained relatively the same. In our discussions with our licensees, they have expressed wanting to continue to increase slot counts to bring their slot counts more in line to what it was pre-pandemic, which was a fairly large difference and would affect the revenue for the state. For volume, I only went back to January just to kind of give you an idea of the volume changes. In January 2025, slot volume was $11.7 billion and up 6.16% compared to January 2024. February 2025, slot volume was $11.5 billion, down 2.7% on the year over year. Again, that's a difficult month for comparison. March 2025, slot volume climbed to $12.9 billion, or up 1.77% year over year. Compared to March, it's an increase, or compared to February, it's an increase of 12.5%. Fiscal year to date, slot win is up 3.1%, and fiscal year to date slot volume is up 2.1%. We haven't been given at the Gaming Control Board any indicators that would cause us to decrease the slot win component of our gaming win. So based on the information and the numbers that we have up to date, we made adjustments to the December forecast and increased our slot win in our forecast models for the forecast period. So now moving over to the table, game and table side. This had a slight effect in the different direction, and it's our next chart where we show the statewide game and table win forecast for fiscal years 25, 26, and 27. Fiscal year 25 game and table win shows a 6.7% decrease from fiscal year 24. For fiscal year 26, we begin to show a gradual climb with an increase of 0.59%. And then in our forecast in fiscal year 27, we show a gradual climb of 1.16%. Again, nothing material on our forecast changes there. To kind of go into those details, we can move into our next slide so I can give you more specific details on game and table win. On this next graph, we've taken our numbers through February 2025. Again, a timing for the March, but March did come out. Game and table win came in at $357 million, which is down from last month, which was at $402 million. Year over year, it's down 14.1%, or $58.4 million. March 2025 game and table volume, however, was up. It was at 3.1 billion, up 91.7 million, or up 3.08% when compared to March 2024. If someone merely looks at win and says that's how we'll build our forecast, I think they would be mistaken. They need to look at both sides of the equation, because you can have a loss and have volume. You can also have little volume but big win. So we look at both of those as factors in building this into our forecast. Fiscal year to date, through March 25, game and table win is down 9.0%. Fiscal year to date volume is down 2.6%. And with regards to Baccarat, which is again a volatile game and does impact our table game side, Baccarat win is down fiscal year to date 18.9 million, or 6.28%, and the volume is down 154 million, or 6.53% as of our March numbers. Again, having that one less day on the weekend can also be one of those contributing factors for the numbers being down. With that said, while some of the numbers seem to kind of flip-flop, volume might be up or win might be down, I would like to point out that game and table win is down by single digits, that 9.01%. I also mentioned the volume fiscal year to date. The volume is at 2.6%. We are not in double-digit declines there. Those were contributing factors as we considered what the forecast should be for fiscal year 25, 26, and 27. In our prior slide, the fiscal year showed game and table win at a decrease of 6.7. However, from that new forecast, we again started to show a gradual climb, 0.59%, and then in fiscal year 27, a gradual climb of 1.16%. Again, with the information and the data we had discussions with our licensees. They're very aware and cognizant of their numbers, and they do what it takes because they want to be successful in their business. They want the patrons in their establishment. And so the reason for the increases in the following 2 years is because they are so cognizant of their numbers. They don't sit there idle and run and hide. They will do what they need to do because they want to stay in business and they want to keep things going for them and the patrons. So with that said, that is what was taken into our forecast for the game and table side. So taking us to our taxable gaming revenue on our next slide, I take us through again February 2025. At that time, I didn't have March in there. We didn't have it available, but I do have that number. March's taxable gaming revenue is, and it came in at $1.256 billion. It has remained stable throughout the period, as you can see through the numbers there. The taxable gaming ratios have remained above 90%, with the exception back in June 2024, which came in at 88.48%. Since then, it has never dropped more than 94%. It's always been higher than that in terms of taxable gaming to win ratio. Currently, as of March 2025, we are at 95.75%. Again, another factor when we came up with our numbers for our percentage fees. That takes us to our next slide, where we have updated our percentage fee forecast for fiscal years 25 through 27. Keeping in mind there are two components that make up percentage fee collections. The first component, we have percent fees on gaming revenue. The second component are the EFAs, or the estimated fee adjustments. Fiscal year to date, the percent fee collections are up 11.72% compared to fiscal year 24. Actual compared to actual from fiscal year 24 to 25. Fiscal year 24, it came in at $754.6 million. To date, we are sitting at $843.1 million in collections. So we are up $88.4 million, or 11.72%. When we compare forecast to forecast, we forecasted $731.9 million, and our actual is at the $843. So we were up $111 million, or 15.2% from our original forecast. With that having been said, again, taking all of this into consideration, we forecasted for fiscal year 25, $990.6 million in collections, a 0.93% decrease. For fiscal year 26, we are forecasting $981.1, or 0.95% decrease. And for fiscal year 27, we forecasted $991.9, a 1.10% increase. Now, having given you those positive numbers, you're probably asking why, and it comes from the EFA side of the two-component equation to this. It's not from the collection side, it comes from the EFA side. When we took our forecast, we took into consideration whether there would be growth. We took into consideration if there might be a few drops in some of the numbers along the way. Taking that into consideration, the EFAs will work against our forecasted numbers. That was factored in, and that is what offsets the positive side of the equation and brings us down to those adjustments that you see there. Again, our collections are up. From our December meeting, they're up in general from our original forecast, and our taxable gaming ratios have been stable or in that 95% range. So with that, that is where we came at, this is where we landed, and that's our forecast and our prediction. If you have any questions, let me know. Thank you, I'd be happy to answer them.
I don't know about questions, I've got a couple of observations. It's interesting to me, and I'm happy to see the numbers, that all three of the forecasters for the current year have numbers that are higher than we forecasted in December. It's also interesting to me that the numbers for the next 2 years are very close to what we used for our December numbers for all three of you. So I think that's a good sign, you know. I think that we, obviously, from these numbers, we can go down a fair amount and still meet the forecast that we had for December, and I think that's good.
Yes, I mean, seeing that, you know, our numbers are coming in relatively high, we're over the, over the $1 billion. You see the taxable gaming revenue up through March. It looks healthy, and again, we took that into consideration, and we were happy to see the numbers where they landed when March came in.
Thank you very much. Dr. Solario?
Dr. Solario, for the record. For my predictions on gaming win, my previous assumptions still hold. One of the things that I added this time around is that slight decline in tourism that is expected on FY26. However, when I was doing my analysis, I was trying to do all sorts of correlations on gaming win. I was trying to do discretionary spending and tourism, and it seems that this gaming percentage win is something that you can have very slow tourism and really high gaming win, or you can have really low discretionary spending and really high gaming win. So it's like it is driven by a couple people playing baccarat or betting millions of dollars in a poker game. So it's just really, really hard. However, one of the things that I noticed is that this gaming percentage win is very stable. If you take a look at the gaming percentage fees before the pandemic, you will see like stable. It's just at $600 million, all like for 5-7 years. And this is something that I'm expecting to see moving forward, that the gaming percentage fees are going to stabilize to what we're seeing in this moving average. So my forecast, with that in mind, my forecast for FY25, it's moderate growth compared to 2024 of 0.5%, which is around $985.8 million. Projecting a small decline on FY26 due to the slower tourism expectations that we have. That brings the dollar amount to $981.5 million. And for my fiscal year 27, that's an increase of 0.3%, which is $984.5 million. Then I just added extra slide here with my forecast and the actuals from FY22 to FY27. So we've seen that the actuals, the moving average has been around $971.6 million, with my forecast that moving average will go up slightly to 1.2%, which is $903.9 million for the fiscal year FY25 to FY27. So that's where I landed. Thank you.
Thank you. Ms. Powers, good afternoon.
Good afternoon. Thank you, Chair, and the members of the Economic Forum. For the record, Susanna Powers. I'm with the Fiscal Analysis Division. Our forecast for gaming tax begins on page 29 of the Fiscal Division packet. And so that's the first page that kind of describes the tax. And so then I will pick up from Table 2 on page 33. Table 2 presents our outlook for the statewide slot and game and table markets and the changes from our December forecast. Fiscal 25 year-to-date statistics for gaming have remained resilient, especially notable given the challenging year-over-year comparisons to fiscal 2024, which benefited from major events such as the Super Bowl and Formula One race. Our fiscal 25 gaming forecast revisions closely align with year-to-date gaming performance. Next, I'll discuss briefly our gaming outlook. Our economic outlook for the upcoming biennium softened significantly compared to the previous forecast released in December, driven largely by downward benchmark revision to key data. And for reference, our economic outlook is in our packet on pages 2 through 27. Initial employment statistics for the last year had indicated growth in high-wage industries such as manufacturing and construction. However, this year's benchmark revisions revealed those sectors were relatively flat, leading to a more measured employment growth outlook given the level of uncertainties on the horizon. As a result, our wage growth outlook was revised downward, reflecting a moderation in overall wage trends. An important factor influencing our forecast for slot, coin-in, and win performance. Similarly, our visitor forecast for Las Vegas was adjusted lower in response to recent data, which plays a critical role in shaping expectations for game and table drop and win. Our outlook for fiscal 26 is looking the next fiscal year. We expect the games and table segment to remain under some pressure, while slot, coin-in, and win are projected to experience a modest pullback. Looking ahead to fiscal 2027, modest growth is projected with upside potential. A major event on the horizon is the College Football Playoff National Championships in January 2027. This event is expected to boost visitation and gaming activity. Table 1A on page 30 presents our percentage fee collections forecast. For fiscal 25, we have a 0.5% decline from the previous fiscal year to $995 million, then followed by a 1.5% decline in fiscal 2026 to $980.4 million, and followed by a 1.4% increase in fiscal year 2027 to $993.7 million. And I'll be happy to answer any questions you may have.
Thank you. Mr. Levitt?
You know, it amazes me how close the numbers are on this particular one. And let me just propose that we use agency with a 2025 year simply because they're slightly more conservative than fiscal. And then I think we can use our previous forecast for the next 2 years, which is in between the two of the forecasts at least. So I'll make a motion that we use agency for the first year and keep our December forecast for the two next years.
I'd second that motion.
All in favor?
Aye.
Aye.
All opposed? Motion carries. Next up is the insurance premium tax.
Erica Scott for the record. So the presentation begins on slide 14 of taxation's slides in the handout. For this particular tax type, the time series you can see was not as much of a revenue impact with Mint Phase 1 implementation issues. This tax type is not yet implemented in Mint, but is scheduled for this December 2025 Phase 2 implementation. Any kind of significant impacts are not anticipated on the later phases as with the initial Phase 1. Another of note in the time series, it's interesting that we did not see as much of a decline in March of 2020 from the COVID pandemic like other revenue sources like live entertainment tax or sales tax. So premiums were continuing to be paid and tax revenue continued to be collected. With the forecast, we are forecasting premium increases as with the prior December meeting, but also that we assume that consumer spending, the consumers will continue to spend their wages on insurance premiums and maintain that revenue source for the state. On slide 15, the department's current forecast has been increased from the prior meeting due to receiving higher than expected revenue in fiscal year 2025. Therefore, adding in those actuals gave the forecast model a higher starting point than the figures previously anticipated. And the forecast for fiscal year 2025 came in at $656 million. Fiscal year 2026 is $699 million, and fiscal year 2027 at $755 million before any credits are considered. That is for taxation's portion of the administered tax type, the revenues that flow through the Department of Taxation. On slide 16, the table on this slide does not have the proper comparison to the prior fiscal year totals, as the prior year revenues are net any tax credits. But the forecast for growth in this tax type in fiscal year 2025 is roughly 7.3% when we account for those tax credits, and then 6.5% in fiscal year 26 and 7.9% in fiscal year 27. I'll keep this presentation short and open it up for questions if anyone has any for me.
Thank you. Dr. Solario?
Dr. Solario, for the record. For the insurance premium tax, my prior assumptions stayed whole. My additional assumptions to this insurance premium tax is that if the 25% tariffs on autos and auto parts still remain in place, we will expect to see another auto insurance premium rate hikes at the end of fiscal year 26 due to the high cost of repairs of autos due to the tariffs on auto parts. Okay, and if you remember from last fall, we see this insurance increases on auto insurance because one of the main factors was the cost of repairs. So if this 25% tariff is still in place, we will expect to see some sort of insurance hikes because of the cost of repairs going higher, and also the valuations of the cars, newer cars being higher because of these 25% tariffs in it. Also, another thing that I'm factoring into this insurance premium tax is the potential increase of home insurances due to the LA fires. We saw that what happened at the beginning of the year, and sadly, we have very similar weather conditions here in northern Nevada. It's windy, it's dry. We don't have as much of as a population density as in LA, but still, if you're in the insurance business, you might want to reconsider how your insurance houses in places that have similar weather conditions to LA. And another thing too that we need to keep in mind is that if tariffs still in place, we're going to have a higher construction cost, higher repair costs, even higher maintenance costs around houses. If something breaks in your house, you need to go and replace it and whatnot. So that will also drive house insurances up in the near future. With that in mind, I have a forecast of FY25. I'm forecasting a growth of 5.9% to $685 million. Then on FY26, this is where I'm seeing this bump in insurances due to the tariffs. That will bring us to $732.6 million. And then I'm not foreseeing any sort of rate increases on FY27, so that's why my growth now goes back down to 4.53%, which will bring the insurance premium tax to $765.8 million. And then I just want to make a little clarification here. So if you look at my insurance premium taxes, I move up my insurance premium taxes quite a bit from my prior forecast. The reason for this is because I was also forecasting the net. I was not aware that there is tax credits taken against insurance premium taxes as well, so I forgot to add that. Now they're adding in, so now this is a gross insurance premium tax. Thank you.
Thank you. Mr. Nakamoto?
Thank you, Madam Chair. Michael Nakamoto with Fiscal Analysis Division for the record. Before I move on to my forecast, just so you have the information with respect to the other portion of the agency forecast for the insurance premium tax, and that's the surplus lines portion from the insurance division. Their forecasts are between $35.5 and $36 million per year. I believe they had a 0.5% growth per fiscal year in that particular portion. On Table 8, that is added to the forecast to get the total agency forecast, but it was not reflected in Ms. Scott's presentation. That having been said, the Fiscal Analysis Division's forecast for the insurance premium tax is on page 65 of our packet. And normally I would have people look at page 67 if we had a laptop. However, what I'll just kind of go through basically where we changed. And we, if you look at Table 8, we didn't really change our forecast that much. In fact, we came close back to where we were originally in November. We do forecast this on a quarterly basis. So the quarterly premium tax collections, which make up about 95% of the insurance premium tax, the second quarter came in about $3.3 million above our forecast. It came in at about $170.8 million. We had it in December at $167.5 million. The other category, which takes into account prior periods and some of the other categories, such as workers' comp, we increased that by about $3 million just based on heavier activity year to date than we anticipated. But then the surplus lines category that I previously mentioned, we brought that down by $2 million because it's not coming in as strongly as I thought. So the net increase to our forecast is about $4.7 million. And if you were to look at Table 8, we brought our forecast down in December by about $5.9 million from November. So we get closer to back to where we were in November, but we don't get the whole way there. In FY26 and 27, if you look at Table 8, you can see that we increased the forecast, but again, not as much. Basically, as we looked at the economic conditions right now, it's still my belief and my overriding philosophy that insurance, in terms of when people are spending money, and especially during slowdowns or downturns in the economy, they'll change their purchasing patterns. But insurance is one of the last things that they'll stop spending money on because they have things that they need to insure. Whether under mandate or just because it's the wise thing to do. Nonetheless, we did take that into account, and I did bring those forecasts back a little bit in 26 and 27, and then like the increase in the other all other category that I added that $3 million to. I didn't feed that the whole way through the forecast. So you can see our forecast for FY26 is only about $2.2 million higher than what we had in December. And then in FY 2027, it is only $684,000 higher than we had in December, kind of keeping more of a status quo, and we flatten it out a little bit. But again, this is one of the more stable tax sources, and it's a little less sensitive to these sorts of things. So we still have some growth. We just have a little bit less growth than we'd had back in December. And with that, Madam Chair, members of the forum, I would be glad to answer any questions. Thank you.
Let me just make a couple of comments if I could. First of all, I'm happy to see that this one, which is a stable one, is up on it for everyone since our December estimates. And I'm a little, on the agency forecast, I'm a little bit concerned about the size of that, particularly to get up to 790 in the third year. And it seems to me if we use fiscal division forecast for all 3 years, that sort of puts us in secure ground where I would think we're almost guaranteed to get that amount. Where if we go higher than that, then I think there's a risk that we will not achieve it. So anyway, I'll make a motion to use fiscal for all 3 years.
Do I have a second or discussion?
I'll second that motion.
All in favor?
Aye.
Aye. All opposed? Motion carries. Great. Next item is the modified business tax.
Thank you, Madam Chair. Before we get started, and while Ms. Owens is coming up, this is Michael Nakamoto for the record. Based on the direction from the last meeting, we have prepared a consensus forecast for the modified business tax for financial institutions and mining. I think for ease of discussion, it might be useful to have Ms. Scott, Dr. Solorio, and Ms. Owens go through the respective non-financial forecasts, and then I can just do a brief overview of the consensus for the financial and mining, if that works for you.
Thank you very much. That makes a lot of sense. So we'll start with non-financial.
Erica Scott, for the record, with the Department of Taxation. So the presentation for modified business tax, general business, begins on slide 18 of the packet of the handout. So first we look again at the time series that I've included but this total is actually for the modified business tax total revenue, including the financial and mining sectors, just for the time series portion of the graph. So we can see in fiscal year 21 and into fiscal year 22 some of the effects of the Nevada Supreme Court decision and backdating those rate reductions, and when the department issued some refunds there. And then in fiscal year 24, the revenue did not exceed levels in fiscal year 23 due to statutorily required rate reductions. But in the second quarter of fiscal year 2025, we see that the revenue did not reach that of quarter two of fiscal year 2024 for comparison. And this was due to a brief pause in processing of payments out of the old system while we did that initial Mint integration. While modified business tax was not in phase one implementation, the processing had to pause while we did that integration for the phase one tax types. That's not anticipated to be as much of a halt or pause during any of the other phases to come, just to put that on the record. So in the next slide, slide 19, the forecast for the general business portion of the modified business tax includes the assumption of continued wage growth, although at a slower pace than what was anticipated at the December meeting, just based on some of the wages seen reported. And so in fiscal year 25, we forecast $819 million, $844 million in fiscal year 26, and $877 million in fiscal year 2027. On slide 20, this is the chart that I did add back in the tax credits for proper comparison to fiscal year 24 and fiscal year 25. And the expected growth rate is 2.7% in fiscal year 25, 3% growth in FY 26, and 3.9% growth in fiscal year 27. And I'm happy to answer any questions on this tax type.
Thank you very much. Dr. Solario?
Dr. Solario, for the record. Modified business tax, this is another one that I was having issues with once we were done with the November forum. I went ahead and looked at my actuals, or the December forum. I want to look at my actuals to see why my actuals were not matching my colleagues. And the issue that I was having is that I was forgetting to put an extra piece of the modified non-financial business tax into it, so that's why my actuals were lower than my colleagues. So once I added that extra piece, it matches. So right now, that's why my numbers increase as well on this one. So it's just, a rookie mistake, a newbie mistake, you can call it. With my new assumptions on modified business tax, is that I'm expecting employment to remain relatively stable with some hiccups on FY26, as I mentioned at the beginning of my presentations. Business expansion is likely to be limited due to heightened economic uncertainty and risk aversion. All business owners, we'll talk about this, they're probably not going to be expanding as much as we would like because of all the uncertainty that is going to happen. Saying this, the revenue growth that I'm projecting here is mainly going to be driven by wage increases, adjustment for inflation and relatively employment levels, rather than large-scale hiring or business expansions. Okay. With that in mind, my forecast for FY25, I'm projecting a growth rate of 2.1%, which equates to $118.7 million. For FY26, this is when we're going to have the most kind of uncertainty going on, the most risk aversion from business. So I'm projecting we're going to have a slight growth of 1.5%, which is going to be mainly driven by some sort of a stable employment and adjustment of wages. And then on FY27, this is where I see, some sort of resolution on this tariff, some sort of a toning down, business leaders coming together and doing deals and whatnot. So that's why I'm foreseeing some sort of increase on FY27 of about 4.1%, which will bring the modified business tax of $861.2 million. And another point that I want to make here, why it's increasing quite a bit in 2027, is because I'm foreseeing that all the business owners who were planning on doing an expansion of fiscal year 26 will do those expansion of fiscal year 27 once we have some sort of certainty from the federal government. We will see that, okay, it's time to expand our business operations. So that's why I'm seeing that quite high of an increase in 27 because of that pent-up demand from the business side. Thank you.
Thank you. Ms. Owens?
Good afternoon, Chair and members of the forum. My name is Haley Owens from the Fiscal Analysis Division of the Legislative Council Bureau. Our modified business tax forecast material begins on page 73 of the Fiscal Analysis Division forecast information packet. We have a lot of kind of detailed and summary tables. If you want just kind of a simple visual, you can go to page 80, has the bar chart of the recent years and the forecast years. So I prepared a lot of very convincing statistics about our forecast, but it's kind of already all been covered. You've heard it all, so I will try to be brief. Our forecast is down from December for all 3 years, and there's really 3 reasons for that. In the first place, since December, the Bureau of Labor Statistics released their benchmark revisions for Nevada jobs, and that did have a negative impact on job growth in 2024 in Nevada. So kind of before even forecasting, we're in a little bit of a lower job state. Secondly, as you saw from Dave Schmidt from Dieter in his presentation, job growth in recent months has been really weak. It's been really flat. This time last year, we had about 2.5% year-over-year growth in total private employment, and as you saw, that's down to about 0.5%. So the recent trends have been weaker than they were when we thought they were in December. And then the third reason, obviously, is that the outlook has deteriorated. So for those reasons, we don't expect to lose jobs economy-wide in this forecast, but we have lowered our growth expectations both for jobs and wages. So we forecast MBT non-financial collections to reach $815.5 million in FY25, a decline of $13.4 million from December's forecast, although it's still up from FY24. And then $840.5 million in FY26, which is a decrease of $25.1 million from December, still positive year-over-year growth. And then $869.7 million in FY27, which is a decline of $31.1 million from December. And with that, I can answer any questions you may have.
Thank you. Questions or motion?
Yeah, Madam Chair, thank you. Brian Gordon for the record. Just a quick question. We've got the MBTs quarterly. We're now 2 full quarters in. Maybe I missed it earlier in the conversation. We're trending at what growth rate through half the year?
Haley Owens for the record. The non-financial portion specifically is up 2.1% through the first 2 quarters.
Great, thank you.
Let me, when I look at the various forecasts, fiscal, it seems to me, is the one that's the most logical, simply because it's based on increasing growth over the 2 years, and it's somewhat less in all categories than we had for our December forecast, and it falls sort of in between the others. I just think that that's probably as good as we can get, and I'll make a motion that we accept fiscal for all 3 years.
Second motion.
All in favor?
Aye.
Aye.
All opposed? Motion carries. So for the financial and mining consensus forecast, I'll turn it over to Mr. Nakamoto.
Thank you, Madam Chair, members of the forum, again, for the record, Michael Nakamoto with the Fiscal Analysis Division. There is a table on page 285 of the forum packet titled Table 1, MBT Financial Institutions and MBT Mining Agency Fiscal Budget and Consensus Forecasts. And hopefully the title is fairly self-explanatory of what it is trying to do. So basically, late last week, Dr. Solorio, Ms. Scott, and the four of us from LCB Fiscal had a Teams meeting, and we had, as a bit of background, we handled this consensus forecast maybe a little bit differently than we do for like the commerce tax or the interest forecasts. But similar to what we do for the technical advisory committee forecast is that each of the forecasters did their own forecasts for MBT Financial and MBT Mining based on their own assumptions for wages and employment. And then we put all of those together in this table and then decided to come up with what we thought would be the reasonable consensus to bring to you. So with respect to MBT Financial, the numbers that you see in the table, so the $42,091,000 for FY25, $43,503,000 for FY26, and $45,144,000 in FY27. This was the average of the forecasts between the Department of Taxation and the Fiscal Analysis Division. With respect to how that changes from the December forecast, it is a decrease of $709,000 in FY25, a decrease of about $1.2 million in FY26, and a decrease of about $1.7 million in FY27. With respect to mining, the forecast or the consensus forecast that you see in that table on page 285 is the average between the Department of Taxation, the Fiscal Analysis Division, and the Budget Division, so it's the average of all three. So $20,368,000 in FY25, $20,646,000 in FY26, and $21,095,000 in FY27. Those are all increases compared to the December forecast. The FY25 forecast increases by $358,000. The FY26 forecast increases by $418,000, and FY27 increases by $816,000. As a general observation, as just as a forecaster, I think for mining we can at least point to slightly stronger than anticipated gold prices as possibly driving those forecasts. Otherwise, if there are questions about the consensus, I can try to answer them the best I can. Otherwise, if there are individual or questions about the individual forecasts from any of those, those would be probably better addressed by the individual forecasters who are at the table with me. Thank you.
Thank you.
I don't know that I have any questions, but I'm willing to go ahead. I think the logic of how you guys did it makes sense. So I'm willing to go ahead and make a motion to approve the consensus forecast for the MBT Financial and for, should I do them one at a time?
Ms. Lewis, Michael Nakamoto for the record. As long as it's clearly stated, you could probably do them both under the same motion, as long as everybody else is willing to go along with that.
Assuming everyone else is willing to go along, I'll go ahead and make a motion for the consensus forecast for both financial and the MBT mining.
I'll second that.
All in favor?
Aye.
Aye. All opposed? The motion carries. Thank you for that summary. Next on the agenda is the real property transfer tax. Ms. Scott, whenever you're ready.
Erica Scott, for the record, with the Nevada Department of Taxation. So real property transfer tax, back to my key assumptions since the December meeting. These changes we've made to the forecast from our agency is based on actuals that are coming in on real property transfer tax, which is coming in higher than expected from the last meeting. The assumption is that pent-up demand is still, for real estate, is still at play here, and continued to be at play in our forecast for this biennium. So the department's forecast is higher, and quarter two of fiscal year 25 came in about 20% above fiscal year 24 year-to-date totals. And while the sustained higher interest rates that we're assuming is also going to be at play here, it's anticipated to affect not as much for the new home purchases. Existing homeowners are probably not going to be changing up and buying unless life circumstances makes them do so. However, new homeowners will continue to buy at the market rate currently. So that is in our forecast. So the general fund portion of the real property transfer tax, we've forecasted at $129.4 million in fiscal year 2025, $133 million in fiscal year 2026, and $138.5 million in fiscal year 2027. Slide 23 of the packet shows the growth rates, indicates the growth as 18.7% in fiscal year 25, 2.8% growth in FY26, and while the market somewhat softens in fiscal year 26, then stabilization of the growth of 4.1% in fiscal year 27 in this tax type. And with that, I'll be happy to answer any questions.
Very clear. Thank you. Dr. Solario?
Dr. Soler, for the record. For the real property transfer tax, all assumptions, they still hold. Homeowners with historically low mortgages are unlikely to sell because they're locked into really low interest rates. New residential developments will slow down due to high construction costs, and this assumption was made in November before we knew what's going to happen with the tariffs. So these new residential developments might slow down even more due to the tariffs, the high construction costs. One of the things that we added into this model now is the mortgage rate expectations now have shifted. Okay, prior we were looking at a stabilization at around 5% of mortgage rates, but now due to persistent inflation pressures, elevated treasury yields, and the delay of the Federal Reserve cutting interest rates, mortgage rates are now projected to stabilize between low 6 and mid 6% in range through the next biennium. And I have a picture to show you. With this in mind, this will continue to suppress real estate transaction volume, particularly among rate-sensitive buyers. So on the slides that I have here for the November 2024, these are the rates that Moody's was projecting on November. So if you see the average projection that Moody's has for the mortgage rate was around 5.6%. When I went ahead and did this analysis again on May 2025, and now the projections are 6.41%. Okay, and I was doing some sort of calculations between, how much would that mean in interest payments if I borrow $400,000 for the bank to buy a house? In 5 years, I'm going to be paying the difference between the 5.6 and the 6.4 is going to be like $12,000 on interest just on that. And then on top of that, you need to add into consideration now that home buyers, we've seen this slowdown of the housing market at the beginning of this year, because now home buyers need to factor in the higher cost of necessities, groceries, medicines, everything else like insurance. Now insurance is going to go up, so what's going on? Will home buyers going to be able to afford a $2,600 mortgage? Moving forward, that's the situation. And the heat up that we saw at the end of FY24, I was looking at it, why are people buying a lot of houses in FY24? And what I found is that people had that expectation that rates were going to go down, that everything is going to be fine with the economy and whatnot, but surprise, nothing is going to go down. It might go, the interest rate might go up if the Federal Reserve banks decide to combat inflation instead of unemployment. So now we're seeing that households are hitting the brakes on home buying because they don't know if they're going to be able to afford the higher prices of mortgages, given that everything else is going to go up as well. With that in mind, my forecast for FY25 it's around $120.6 million, which is quite close to what we are year to date. So I see that we're going to be closing really close to what we are year to date. But on fiscal year 26, once we start seeing the higher cost of goods moving up, we're going to see some sort of a slowdown from home buyers because they're going to be more cautious about getting a $500,000 mortgage loan if they're factoring in that everything else is going to be very expensive. So that's why my forecast for FY26, I have it going down to 5.5%, which equates to $113.9 million. And then on FY27, as everything starts to stabilize, hopefully we'll see some sort of cuts in FY27, but honestly, it doesn't look like it's going to happen. So that's why I'm going to see some sort of a modest growth of 1.8%, which will bring it to $116 million for FY27. Thank you.
Thank you. Mr. Nakamoto?
Thank you, Madam Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. The Fiscal Analysis Division's forecast for the real property transfer tax is on page 101. Normally, I would bring up page 102 of our packet, which has our forecast spelled out by quarter, and this is one where we do a quarterly forecast. The actuals that have been reported by the Department of Taxation, as previously noted, are through the second quarter. The second quarter of FY25 was 33.8% above the previous fiscal year, and it was approximately $6.4 million above our forecast that we presented back in December. And there is a lot of strength both in Clark County, which was up 39.6%, as well as in Washoe County, which was up 27.1%. The third quarter, the number that we have in our forecast of $28,637,000 is actually a fairly good number. This is about the point where I can say, well, you know, we go into the state controller system because this is remitted from the counties to the state, and we can look at what they have been sending us. When we did the forecast, we had 15 of the 17 counties in. We were missing Pershing and Esmeralda counties, which I figured, well, was worth about $15,000 or so. I looked, and yesterday, and it's showing up this morning, Pershing County has showed up. It's worth $14,000. So Esmeralda County needs to get to $1,000, and my forecast for the third quarter looks pretty good. But what that means in actual terms, the $27.8 million is a 10.3% increase. And it is about $800,000 above our forecast from December. Clark County was up 16.7%. Washoe County is up about 8.4%. They're not as strong. Most of the strength is in Clark County. And so then that brings the question of, okay, what do we think is going on here? One of the assumptions that we had made back in December is that there was going to be a stabilization of home prices. That hasn't occurred yet. And it's one of the things that's really surprising because, you know, Dr. Solorio talked about interest rates. We've talked about interest rates back in December, and we were thinking, you know, with the higher interest rates, you would think that there might be a little bit of downward pressure on prices because of softened demand, and that really has not seemed to be the case. What I think is still going on is that you have a significant amount of cash purchases coming from out of state because people have equity and they are deciding to come here. So our forecast for FY25 largely takes into account the increases that we've seen. Our forecast increases by about $7.5 million. And again, this is mostly driven by the second quarter and the third quarter. We add a little bit in the fourth quarter, but not too much. But if you look at Table 8, that you'll see that our forecast, that growth does not carry through. So we grow by about $4.2 million in FY26 and only by about $2.7 million in FY27. And one of the things that was an observation that I read about not too long ago, and it makes a lot of sense to me, is that there is perhaps in terms of economic uncertainty, or in these times of economic uncertainty, the people who may be willing to move from California or other higher cost of living places and pay cash in Nevada, be it in northern or southern Nevada, that might be a little bit diminished because it involves uprooting your families, possibly your job. And in an environment where it might be a little more difficult to find an employment, people might be less likely to do this, and they might stay in a situation where there is at least some sort of stability to kind of ride this out. So what we see going forward is the demand will settle out a little bit, prices will set out a little bit, and while there still is growth in our forecast, we've pulled that back a little bit just with the idea that some of the people, irrespective of interest rates, because again, I think interest rates don't play as much of a role in this facet as we might have previously thought, but people may be a little less willing to move than they had previously. I think interest rates for the people who are here who might decide to downsize or change their arrangements might play into it a little bit as well. But I think there will be some softening in the market. We're not talking like 2008 Great Recession type softening, because I don't know if softening is the right word for that. But I think we will still see some increases, but maybe not as much because just of the changes in conditions and a little bit of uncertainty. So with that, Madam Chair, I would be glad to answer any questions. Thank you.
Thank you. Mr. Gordon?
Thank you, Madam Chair. The background is helpful in sort of understanding how the forecasts were put together across the board, particularly that we're tracking ahead of schedule through this current fiscal year. So taking a look at each of the forecasts, I would make a motion to accept the fiscal division's forecast for real property transfer tax.
I'll second that.
All in favor?
Aye.
Aye.
All opposed? Motion carries. The last major general fund revenue source is the commerce tax, which again is a situation where we have a consensus forecast. Mr. Nakamoto, do you want to make any comments on that?
Absolutely, Madam Chair. Michael Nakamoto with Fiscal Analysis Division for the record. The Commerce Tax consensus forecast information begins on page 287 of the Economic Forum packet. So this is, in fact, we did this the same day that we did the MBT consensus. This is one where it's something that's a little different, where the Fiscal Analysis Division puts together some information, and then we send that to the Department of Taxation and the Budget Division, and then we have a conversation about the assumptions. And so the methodology that we are using for this is identical to what we've been using for the forecasting of this since we started forecasting the commerce tax in front of this body in November of 2016. So what we have on table 1 is looking at the commerce tax by business activity period. So irrespective of when the tax is actually collected and remitted, the tax activity year that the collections belong to. And so one of the things that we look at as kind of a gauge is the actual and forecasts of gross state product that we get from Moody's Analytics. And so back in November of 2024, the forecast, the baseline forecast that Nevada had for Nevada gross state product was an increase of 5.3% in FY24 and an increase of 5.4%, an increase of 5.3% in FY25, and increases of 5.4% per year in FY26 and 27. The most recent forecast from Moody's for Nevada gross state product decreased, as it would not be surprised, to 4.7% in FY25 and 26, and 4.5% increase in FY27. So still above inflation, but it is lower than it was. So the end result is on the right-hand side of that table. You can see kind of the consensus growth for the activity period collections for the commerce tax, where in November we were at 6% growth in FY25 and 5.5% growth in FY26 and FY27. We brought that down in terms of activity period collections to 5% per fiscal year in FY25, 26, and 27. So on the next page, on page 288, is taking those collections, translating them back to the accounting period. And so this was one back in November. We had talked about how there was the increase in prior period collections in FY24. So a lot of collections in FY24 were attributable to previous periods. So that 5% collection or the activity period amount actually decreased down to about 3.2% when you translated it back to the accounting period. And so we're keeping that in line. The information we've gotten from the Department of Taxation says that we're not getting as many prior period collections thus far in FY25 than we had been in FY24. So we kind of left that the same. So that growth rate continues, and that is why you have the reduced growth rate now of 2.3% in FY25 compared to FY24. But then you can see in FY26, the growth rate for collections goes down to 1.6%, and it's a decrease of $13.6 million, and this is a Mint issue. So basically, the commerce tax is in a phase of Mint that will be implemented at the end of fiscal year 2026. And so the end result of this is that instead of, under the current law, the commerce tax is due 45 days before or after the end of the fiscal year. So unless it falls on a weekend or a holiday, August 14th is the due date. And so that gives enough time for the Department of Taxation to collect commerce tax for about a month before under the current law, so that they can report it, get it posted into the controller system before the fiscal year closes on the third Friday of September. Under Mint, beginning in FY26, the close of the fiscal year as far as Mint is concerned is August 30th. So it cuts off this window of about 2 weeks after August 30th and up to September 14th, of which anything that's after August 30th now is going to post in the subsequent fiscal year. And this is an absolute non-negotiable hard stop for Mint, as it has been relayed to us. That having been said, based on the information we got from the Department of Taxation, that 2 weeks of commerce tax is not of the magnitude that 2 weeks of sales tax is. The reduction of that $13.6 million reduction in our forecast, approximately $8.5 million, is because of that Mint issue of money that would have posted in FY26, but now will post in FY27. With the balance of that, about $5.1 million being because of the decrease in our assumptions. Pardon me. And then in FY 2027, that annualizes, so we don't have to worry about Mint. It's a one-year thing, but our forecast still does come down by about $7.2 million in FY 2027. Along the same lines, on page 289, and then it's also on table 8 are the commerce tax credits. As you will all recall, up to 50% of a taxpayer's commerce tax liability in a fiscal year can be used against their modified business tax liability in the subsequent fiscal year. Because we have reduced our forecasts for the commerce tax, it also reduces the forecast for the commerce tax credits, because fewer credits available means fewer credits will particularly be issued. And so the net change to the commerce tax credit forecast, that if you look at table 8 on the next to last page, of $66,388,000, and these are negative numbers, is a decrease in the amount of credits of approximately $1.2 million. And this actually results in additional revenue. The decrease in credits means additional revenue that comes to the state general fund. In FY26, the $69,741,000 results in increased revenue of approximately $642,000 in this forecast. And then in FY27, $73,227,000 in credits results in approximately $1,037,000 in additional revenue due to the decreased credits. That was a lot to go through, Madam Chair and members of the forum. I will be glad to answer any questions. Thank you.
Thank you. I think that concludes agenda item 10. Oh, sorry, we need a motion on the commerce tax and the credits.
I'll make a motion that we approve the consensus numbers for the commerce tax and the commerce tax credits.
Second.
All in favor?
Aye.
Aye. All opposed? That motion carries.
And Madam Chair, before we finish agenda item 10, there is the last missing piece. There is a forecast that falls out of a forecast that was previously approved by this body. If you look at the Economic Forum table, sorry, Michael Nakamoto with Fiscal Analysis Division for the record, I need to remember that because that's my job. They are underneath the sales and use tax, there are the sales tax commissions. Those are driven by a formula that it takes into account the rates and how much of that is retained by the state general fund. Based on the actions that were approved by the this body with respect to the sales and use tax forecasts, the general fund commissions that will be added to the forecast. So if you're going through and trying to add up all the pieces plus the non-majors, you would need to add these amounts as well. So for FY 2025, it would be $73,757,000. For FY 2026, it's $75,312,000. And in FY 2027, the amount is $77,827,000. And so once those are added in with the approved majors and non-majors, that hopefully will balance as the tables are checked and verified. But I thought I would give you that information while we were still under agenda item 10 before we move on to the non-majors in agenda item 11. Thank you.
Thank you. Hard to put the puzzle together with that missing piece. So agenda item 11 is the review and approval of forecasts of minor general fund revenues and tax credits for FY 25, 26, and 27, approved by the Technical Advisory Committee on Future State Revenues at its April 23rd, 2025 meeting. Mr. Nakamoto?
Thank you, Madam Chair. Again, Michael Nakamoto with the Fiscal Analysis Division for the record. It seems like it was more than 8 days ago, given how things are going, but the Technical Advisory Committee did meet as requested by this body to consider non-major revenue forecasts and tax credits on last Wednesday, April 23rd in this building. The relevant tables for this agenda item are found in the Economic Forums packet. Table 5, which is kind of the companion of Table 4, but only for the non-majors, is on page 297 of the packet. Table 6, which is the summary of the entire forecast that we will be going through today, is on page 299. Table 6 difference begins on page 311, and this is the difference between the forecasts approved by the Technical Advisory Committee at their meeting last Wednesday compared to their meeting back in November of 2024 before the December meeting. And then Table 7 on page 317 kind of summarizes the information into something that is a little more digestible. In the interest of time, Madam Chair, I did not intend on going through all of the information, but I thought I would go through the highlights, keying in on some of the more significant differences and issues that needed to be addressed with respect to the with respect to the forecast. And please give me 1 second. Sorry, I'm a little out of sorts right now. Again, Michael Nakamoto with Fiscal Analysis Division for the record. So if you want to look at Table 6 or 6 difference, probably does not make a huge difference. Maybe Table 6 might be better beginning on page 299. The first one that I'm going to point out is gaming penalties under the gaming block, GL 3042. You can see that the forecast that was approved by the Technical Advisory Committee for FY 2025 was $11 million. The $11 million is in this forecast is predominantly due to a $10.5 million penalty that was levied on Resorts World back in late March by the Nevada Gaming Commission. This is one where the timing was a little bit unfortunate, because I'm sure all of you have seen recently in the news about an additional penalty that the Gaming Commission was looking to levy against MGM in the amount of $8.5 million. The Gaming Commission met the day after the Technical Advisory Committee, so because of the timing there, we were not in the position to add any revenue for that particular penalty. But now that the Gaming Commission did meet last Thursday and they approved the issuance of that penalty, when we get to the point where the forecast is approved, and this is at the direction of the Technical Advisory Committee because we let them know that this issue was going on and the uncertainty around it, our recommendation as staff would be that if you are to approve the Technical Advisory Committee's forecast for the Economic Forum, that you allow staff to make an upward adjustment of $8.5 million in FY 2025 to account for that additional revenue from that penalty, based on the information that we've gotten from Ms. Newell at the Gaming Control Board. Because of the timing of when it was levied, it is anticipated that that money will be paid into the State General Fund by the conclusion of FY 2025. So other than that, on this page, I would point out the Transportation Connection Excise Tax, which is the Uber, Lyft, taxi cab tax. It's 3% of the fare. There were downward revisions in all 3 fiscal years for that, approximately $1.5 million in FY 25, about $2.8 million in FY 26, and about $3.7 million in FY 27. And this was primarily attributable to downward outlooks on visitors. About 90% of this tax, from what I can gather, is generated in Las Vegas, and so it is very tourism heavy and tourism dependent. The cigarette tax is next. This is a tax that was affected by Mint, but we took that into account as part of the forecast. There were downward revisions of the tax, or of the forecast, of approximately $597,000 in FY 25, about $212,000 in FY 26, and about $568,000 in FY 27. And I think this was all of the forecasters looking at it and saying people are not smoking as much as we thought they would. So this is not so much of a Mint adjustment. This is that we don't think the tax is doing quite as well as we thought. So the next page of Table 7 is the modified business tax, and since there are no forecasts for that, you can skip that and move on to the third page of Table 6. And I only have really one to talk about here. Actually, no, I take that back. I have 2. And the first is the business license fee, which is predominantly collected by the Secretary of State's office. There was an increase in the forecast of $114,000 in FY 2025, but decreases of approximately $1.9 million in FY 26 and about $1.2 million in FY 2027. And I think the reasoning behind this is the tax is holding fairly well during this fiscal year, but I think there might be some downward pressures on it based on the uncertainty. This is in large part coming from out-of-state corporations and other business entities who come to Nevada to do their entity filings. And so there may be an expectation that those soften a little bit, which is going to sound weird when we get to the commercial recordings on the next page, but that is kind of how the forecast went with respect to that one. The liquor tax, GL 3050, had significant downward revisions in all 3 fiscal years. This is another Mint issue, and I think this is one where we found it perhaps a little difficult to sleuth out whether it was a Mint issue or whether it was an activity issue. But this is one where we could actually see with decreased tourism demands and visitor volumes where you could have a softening of liquor tax because there is a large consumption of alcoholic beverages by Fiscal Analysis Division staff as well as visitors. So there's a decrease of about $3.9 million in FY 2025, about $4 million in FY 2026, and about $3.3 million in FY 2027. And then that's all I really had on this table. I'll skip tax credits for now, and we can go to those to the end. But is this a good time to stop to see if there are any questions about the taxes, Madam Chair, or should I just go through the entire table?
Please proceed.
So then on the next page, under licenses, there are a few that are worth noting here, three of them are for the Secretary of State, and the first one is GL 3105 UCC. It's the Uniform Commercial Code filings. There is a significant downward revision in terms of percentages. This probably has the largest percentage downward revision of all of the forecasts. It's about $560,000 in FY25, $577,000 in FY2026, and $593,000 in FY2027. And the only thing that I can really come up with on this is during the pandemic, and I think it was one of the conditions for a lot of the federal stimulus programs, especially like the PPP loans and things like that, that one of the conditions to receive those is you had to have certain UCC filings with your state regulator. And so those spiked during the pandemic. But I think as time has progressed, the demand for those has lessened significantly. And so the forecast that you see there of just under $3 million in FY25 and growing up to just over $3 million, those are in line with the historicals, and I just think it was the last few fiscal years were abnormally high, and it's coming back down to normal. And I think this is something that we didn't anticipate back in December or in November, pardon me, when we had the original forecast. But now the year-to-date collections are just not coming in, so there was a reduction in the forecast. For commercial recordings, GL 3130, the forecasts that you see do have a slight upward revision of $755,000 in FY 2025, about $824,000 in FY 2026, and about $1.3 million in FY 2027. And so when I said it probably doesn't make a lot of sense with respect to when you go back and look at the business license fees, that would be it. But we're seeing that year-to-date, this is actually performing fairly well. So I think, at least for fiscal, we just kind of built that into our outlook. We didn't change it that significantly, but we also had fairly conservative growth in this as well, seeing that given even the uncertainty that we were seeing back in December, that could kind of float through as well. And then securities, GL 3152 had increases of $659,000 in FY 2025, $686,000 in FY 2026, and $703,000 in FY 2027. And this is based on year-to-date actuals coming in stronger than we had anticipated and just kind of more or less flowing that through the forecast. Pardon me. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. The last one under licenses that I figured I would note is GL 3102, the Athletic Commission fees. This is it's an 8% fee that the Athletic Commission levies against admissions for unarmed combat, so boxing, mixed martial arts, and so on, of which 2% is retained by the agency to fund their operations, and 6% goes to the state general fund. There is a significant downward revision in all three fiscal years, about $1.5 million per year in FY25 and FY 2026, and about $1.6 million in FY 2027. The Athletic Commission basically thought, the sanctioned events under their purview were going to be less in FY25 and then throughout the forecast horizon, and we did not disagree with that. Basically, I think it's not that UFC or these types of events are any less popular, but they have an international audience, and so they are just as likely to have their fights in Mexico City or Dubai or Tokyo or London as they are in Las Vegas. So they're branching out and having their events elsewhere. So that does result in a decrease of the forecast. So for total licenses, the decrease was about $849,000 in FY 2025, about $814,000 in FY 2026, and about $384,000 in FY 2027. Moving down to fees and fines on the same page, there is exactly one that I am going to mention, and that is the short-term car lease, GL 3066. where there was a downward revision of about $1.7 million in FY 2025, about $2.6 million in FY 2026, and about $3.2 million in FY 2027. Again, this is one that is fairly heavily dependent on tourism and with softening expectations on tourist activity, particularly in the Las Vegas Valley. The decision was made to reduce those forecasts accordingly. So the total fees and fines, the reductions were about $1.5 million in FY 2025, about $2.5 million in FY 2026, and about $3.1 million in FY 2027, again, largely tracking with the short-term car rental. On page 5, under use of money and property, there were no changes to any of those repayments. Those are basically set by statute, so what the forecast is what the statute says. The only changes to this were under other interest income, GL 3291, where there was an upward revision of $34,500 in FY 2026 and $63,700 of upward revision in FY 2027. FY 2025 was unchanged. And then finally, under other revenue, there are a couple that I'm going to mention. First is expired slot machine wagering vouchers, which had a decrease and about $250,000 in FY 2025, $368,000 in FY 2026, and $462,000 in FY 2027. This was Ms. Newell's forecast from the Gaming Control Board, just with the changes in expectations, having those vouchers soften a little bit. But the one that is worth mentioning the most on this page is GL 3255, unclaimed property, which is the last one on this list. And this had a significant upward revision in FY 2025 with smaller revisions in FY 2026 and 2027. And the increase of about $8.9 million in FY 2025 was largely due to the fiscal analysis division. This is the program by which certain assets on abandoned bank accounts and so forth get turned over to the treasurer's office. They put people's names on the list, and you can go to the unclaimed property website and look up your name and see if you have anything, and if you do have something, then you can apply to receive a check for that back. So under this program, anything, they have certain expenses that they have to pay, and then a couple of required transfers that they need to make, but then the balance goes to the state general fund. As we were looking at what had been coming in terms of the deposits and various receipts that are being paid into this account, they had gone up. I was looking, it was about $136 million that had come in, and then I looked 4 days later, and it was up to $146 million. $10 million in 4 days is a little bit unusual this time of year. It is more money than I can recall ever having come into this. And so looking at the amounts coming in and then the amounts going out, I thought it was prudent to increase our forecast, and so you ended up with that forecast increase of about $8.9 million. The way that it was relayed to me from the treasurer's office was that a lot of these deposits coming in FY25 were more one-time in nature, and it wasn't going to repeat, so I didn't have that amount coming back in. So there were smaller upward revisions in FY 2026 and 2027 of about $2.5 million in FY 2026, and then $144,000 in FY 2027. So the bottom line with respect to the total revenues, and this is with that $8.5 million added in. So before tax credits, the FY 2025 forecast is $798,260,078, which is a 1.1% decrease compared to FY 24. FY 2026 is $766,355,284, which is a 4% decrease compared to FY 25, and in FY 2027, $773,821,284, which is a 1% increase compared to FY 2026. In terms of changes from the November TAC meeting, for FY 2025, before tax credits, that amount that I read off is $18,996,800 higher then was approved by this body at the December meeting. And then in FY 2026, the total that I read was $10,340,100 lower than was approved by this body at the December meeting. And then in FY 2027, this total was $12,887,600 lower than was approved at the December meeting. So before we go on to tax credits, which will be fairly quick, I will see if there are any questions.
Please proceed.
Thank you, Madam Chair. Again, for the record, Michael Nakamoto with the Fiscal Analysis Division. There are only a few changes to tax credits that I would like to highlight. The first is the Film Transferable Tax Credit Program, which had upward revisions to all 3 fiscal years, most predominantly in FY 2026. And the reason for this, back on April 3rd, the Nevada Film Office, who administers this program, approved a preliminary tax credit amount of approximately $4.2 million related to WrestleMania and the associated events for that. So I think we've set a record for the number of times we've mentioned WrestleMania in an economic forum meeting, but that is, I digress. So there is an upward revision to the film tax credits, and it's primarily in FY 2026. Most of the rest of these are largely unchanged. There's a little bit of movement on the Education Choice Scholarship tax credits in that we have a little bit less, or actually a little bit more in credits being issued or awarded and used in both FY 2025 and FY 2026. There was a question that we had when we were back at the December meeting because we were approximately a month away from a bunch of credits because they have a shelf life of 4 years expiring. And we were like, well, are they going to get used or are they not? And I think our assumption was that there were going to be more that expired than did. So more got used, and we think because of the timing and how that works out, they will end up being used a little bit more. So the forecasts for the Education Choice Scholarship credits are $400,000 higher in FY 25 and $500,000 in FY 26. Then the Affordable Housing Transferable Tax Credits, these are forecasts that were given to us by the Housing Division of the Department of Business and Industry. They increased their forecast of the amount of credits being used in FY 2025 by $1,725,000. And then in FY 27 for $1,275,000, or so a total of $3 million over the 3-year period. And so the way that this works is they kind of use this as the last piece of the financing for affordable housing credits. There's federal money, there's state money, matching loans, all kinds of financing that comes from all kinds of places, and this is the last piece. There was a lot of federal ARPA money that went to affordable housing to the tune of $500 million, but as we get closer to that money having to be used by the end of calendar year 2026, the expectation is, I think, that they're relying a little bit more on the credits to spread it out, and then eventually that money's going to go away. So they'll use more of these credits. And then the baseball stadium is on at $36 million per fiscal year. That is unchanged. So the forecast that you have for tax credits of $53,346,458 is $2,350,358 higher than the December forecast. So that is that amount of money that is now not available for the state to use. It reduces the forecast. Then in FY 2026, the forecast increases by $6,584,647, which is that $77,895,297 amount is the $5.6 million higher than the December forecast. And then in FY 2027, the total of $86,430,700 is $3,275,000 higher than from the December forecast. So that is, again, less revenue that is available. So, Madam Chair and members of the forum, the net after-tax credits based on the forecast that is in front of you with the addition of that $8.5 million for the gaming penalty for MGM. The total for FY 2025 is $744,913,620, which is $16,646,442 higher than the December forecast, but it is a net 3.1% decrease compared to FY 2024. In FY 2026, the total of $688,459,987 is a 7.6% reduction compared to FY 2025. It is also a reduction compared to the December forecast of $15,924,747. And then in FY 2027, the total of $687,390,584 is a 0.2% decrease compared to FY 2026, and it is a decrease in the forecast of $16,162,600. And so with that, Madam Chair, that is all that I had for Agenda Item 11, and I would be glad to answer any questions.
I'll make a motion to approve the revenue estimates as determined by the Technical Advisory Committee, with the addition of the gaming penalty that you've discussed with us, as well as the various tax credits that you've just immediately discussed.
I'll second that motion.
All in favor?
Aye.
Aye.
All opposed? Motion carries.
Thank you, Madam Chair. Michael Nakamoto for the record. You probably saw at some point that the rest of my team abandoned me. And we originally had a reason for doing this, and this was the realization that 3 of the 5 of you had a flight to catch at 4:55, and we were trying to accommodate that. And with everything that has gone on today, that really hasn't worked out exactly as we would have planned. So your flights have been changed. That has been taken care of. The flight is now at 6:35, and I am sorry to have to be the bearer of that news. But that having been said, Madam Chair, this is the point where we would take the lunch break. There is lunch available for all of you. I believe they had to remake it, in fact, but because it had been sitting around for a little longer than they might have liked. But this is, we will go back and we will put in the tables, make sure everything is ready to go. There's also the letter that all of you will sign that we have to make sure that is prepared, and we'll have an additional table that shows the difference. So at this point, Madam Chair, I think this is the point where we go back into recess. We always say an hour, but and we'll try to keep it to that. But if it goes a little bit more than an hour, then please don't be surprised or alarmed.
Thank you. So with that, we will adjourn this meeting, recess. I'm getting all my words. Again, adjourn. Recess this meeting. Do we want to say specifically for an hour, or?
We'll just say, how about the call of the chair?
Okay, we will recess this meeting until I bring us back to order. Thank you. Hello again. For the record, Linda Rosenthal. We are reconvening the May 1st, 2025 meeting of the Economic Forum. We are currently on agenda item 12, approval of the Economic Forum's May 1st, 2025 revenue forecast report. Do I need a motion to, nope. Okay. I'll turn the meeting over to Mr. Nakamoto.
Thank you, Madam Chair. Good afternoon, members of the forum. For the record, I am Michael Nakamoto, Chief Principal Deputy Fiscal Analyst with the Fiscal Analysis Division. So under agenda item 12 is the approval of the Economic Forum's May 1st, 2025 revenue forecast report. There are 3 components that you all have and have had the opportunity to review, but to go through this for the benefit of the public, and both here in Carson City, down in Las Vegas, as well as anybody online. I will kind of go through what the sum of the decisions and then talk about the components of the report. So the very first thing is the Economic Forum's May 1st, 2025 table, which is taking all of the decisions that were made today, the Technical Advisory Committee's forecast with the addition of that $8.5 million in gaming penalties for FY 2025, as well as the tax credits, and then all the decisions on the major revenues, and the sales tax commissions that fell out of that, and came to a bottom line, which for FY 2025, before tax credits, is $6,148,678,078, or a 0.7% increase compared to FY 25, or to FY 24. In FY 2026, it is $6,183,974,284, or a 0.6% increase compared to FY 26, or to 25. I'm tired, apparently. And then in FY 27, the total before tax credits is $6,365,559,284, or a 2.9% increase compared to FY 2026. After tax credits, FY 2025 is $6,028,943,620, or a 0.3% increase compared to FY 24. FY 26 is $6,036,337,987, or a 0.1% increase compared to FY 2025. And then in FY 27 is $6,205,901,584, or a 2.8% increase compared to FY 2026. The second table that you have that will be part of the report is titled Economic Forum General Fund Revenue Forecast Comparison for the May 1st, 2025 forecast versus the December 2nd, 2024 forecast, and that basically lays out the comparison between the two forecasts. So before tax credits, in FY 2025, the approved forecast today is $19,014,800 higher than the Economic Forum's December forecast. In FY 2026, the approved forecast today before tax credits is $92,448,100 lower than what was approved at the December 2nd meeting. And then in FY 2027, the total is $91,247,600 lower than what was approved at the December Economic Forum meeting. After tax credits, and this is the one that matters the most for the budget, the FY 2025 revised forecast that is under consideration today is $17,902,442 higher than the December 2nd forecast that was approved by this body. FY 2026's forecast for today is $97,390,747 lower than what was approved at the December Economic Forum meeting. And then the FY 2027 forecast is $93,485,600 lower than what was approved at the the December meeting. So net of tax credits, the legislature has, for this current biennium, based on the 2024-25 actual, the total forecast after tax credits is $20,827,681, which is the $17,902,442 higher than the forecast from December. And then for the upcoming biennium for FY26 and 27, the total forecast net of tax credits of $12,433,115,918 is $190,876,347 less than what was approved by the Economic Forum at the December meeting. So that is kind of the highlights of what you have in these tables. The last part of the report is the letter that you all have copies of. It's an identical letter, except for one is for Governor Lombardo. The other one is for the members of the legislature. There are numbers in there as well that hopefully match everything that I just read out, because if there's not, then we might have some problems. But no, we did check them and we went through all that. So we do have copies over at the secretary's table for you to sign after the meeting. And with that, Madam Chair, that is all I had with respect to that agenda item. This would be the point where a motion to approve the report would be appropriate. Thank you.
Madam Chair, Brian Gordon for the record. I first want to just say thank you to the staff that helped make this meeting happen, all of the research that's gone into this. The level of effort's been tremendous, and we all are very appreciative of the work, as well as the departments and all of the speakers and presenters that were here for this particular meeting. We had an opportunity to review the letter and the information that you've provided. I would like to make a recommendation or a motion to accept the letter as drafted, as well as the May 1 Economic Forum forecasts.
I concur, and I'd also like to thank the staff and all the work that went into putting the forecast together, but I would second that motion.
All in favor?
Aye.
Aye.
All opposed? Motion carries.
And this is the point where Mr. Tower behind me will start passing these out to the public so they too can have copies of the tables and the information that you have.
Great. Agenda item 13 is scheduling of future Economic Forum meetings.
Thank you, Madam Chair. For the record, Michael Nakamoto with the Fiscal Analysis Division, and I'm pulling up my calendar real quick. This is the last scheduled statutory forecast meeting for the Economic Forum for this cycle. There is, however, a statutorily required meeting on or before December 10th, which is anticipated to be held in the new building in Las Vegas. We are not at the point where we're really ready to schedule that yet. We will work with the chair based on her schedule, and then work with all of you based on your schedules to accommodate a meeting sometime on or before that 10th day in December.
Thank you very much. That brings us to the last agenda item, which is public comment. I'll start here in Carson City. Is there anyone in the room here who would like to make a public comment? Not seeing anybody, we'll move down to Las Vegas. Is there anybody in the Las Vegas office who would like to make a public comment? Okay, and then finally, I would like to ask the BPS staff if anyone has called in to provide public comment.
If you would like to provide public comment, please press *9 to take your place in the queue.
They're lined up.
Thank you, Chair. The public line is open and working. There's one caller on, but they're not raising their hand to speak. So we have no other callers at this time.
Okay, thank you very much. With that, we'll move forward with adjourning the May 1st, 2025 meeting of the Economic Forum. Thank you all very much.